Chris, just testing audio. Can you hear me? Keith, did you hear me?
Yes, Andy, I could hear you.
Great, thank you.
We can hear you in the conference room as well.
He's big dude.
Thank you.
Good morning, Commissioner. Are you with us?
I am.
Good morning, Commissioner. You are in charge.
Okay, we have 2 minutes though.
Yes, we do.
Indeed you do. Indeed instantly delivers quality benefits matching your job description. Visit Indeed.com.
Yes.
All right, are we ready to call this meeting to order?
Yes, we are.
Andy,
Good morning, Commissioner.
good morning. Can you take a roll call to see if we are, have a quorum?
Good morning, everyone. Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Commissioner Treasurer Montoya.
Present.
Secretary Props.
Present.
Mr. Jennings. Mr. Lavender.
Here.
Mr. Roth, oh, I'm sorry, my apologies. Mr. Summer.
Here.
Mr. Messina. Mr. Tejas.
Here.
Miss Allen.
Here.
Mr. Bingaman.
Here.
Madam Chair, we have a quorum.
Okay, we also
Madam
have
Chair,
some
we get it.
echoing. Yeah.
Chris, how do we fix that, please? Could everyone please go to mute if you are not speaking, and we'll test to see if that helps? All right, Commissioner, we're going to try that. Oh, Chris, we still have feedback.
It's because Andy and NMSIC are both probably in the same room, it seems.
No, I'm in my
No.
office. No.
All right, we're going to test one more time. I
Great.
think you did it. Thank you, Chris. Commissioner, we're fine now.
All right. We have our agenda before us to approve.
I move we approve. It's Harold.
Second, Summer.
Okay, we have a motion to approve the agenda from member Lavender, second from member Summer. Take a
Commissioner
roll call.
Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Okay, and now for approval of our February minutes.
Commissioner, are you hearing the feedback that we hear in the office?
Yes, and actually it's when Andy is unmuted. For some reason. When she is unmuted to take the vote, that's when the feedback is happening on my end.
I think you are correct. Thank you for your technological expertise. Chris, now we know what the issue is. Okay, we're ready, Commissioner.
Do we have a motion to approve our February minutes?
This is Harold. I move approval.
Second, Allen.
Okay, we have a motion from member Lavender, second from member Allen. Andy, if you would take a roll call vote.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Staying.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Great. We could turn it over to our state investment officer, please.
Thank you, Commissioner, and good morning to all of you. Please take a look, if you would, at the State Investment Officer's briefing, which is in your materials. And we'll begin with item A, opening comments. Total distributions for the last 12 months to the state from the permanent funds, $1,238,333,000 plus. February 2023 total land grant permanent fund contribution received from the state land office, which, as most of you know, is lagged 90 days, $200,573,000 plus. Our net asset value as of Friday was $42,236,000,000 plus. New Mexico WTI oil price as of Friday was $66.59 per barrel. As all of you know, there is a differential in New Mexico as compared to the traditional WTI pricing. So the New Mexico differential to WTI is approximately $2.58 discounted from WTI. The $66.59 per barrel price as of Friday compares to a price a year ago, and get ready for this, and yes, this is correct, $111.44 per barrel. So why was that? In March of 22, the 65-cent premium to WTI was caused by the conflict in Ukraine, which increased oil demand. So it was a bit of an aberration. New Mexico rig count as of Friday was 108. That number was 96 a year ago. U.S. natural gas as of Friday was $1.93 per MCF. And that's down substantially from a year ago at $4.56 per MCF. So that covers item A. Any questions on that? If not, we'll move to item B, investment matters. Please take a look at the items listed there under B1, our net asset value detail. And you'll see over 13 years that the net asset value, also known as NAV, has tripled. Let's also look at clients. Our clients have increased from 17 to 26 since February of 2010. All of these things are positive. However, they have substantially increased the workload in the office. They magnify the need for more staff and more competitive compensation. Brent will comment a bit later on our upcoming need for permission to hire more than 26 full-time equivalent staff members. As I've mentioned to you many times, we started at 31 FTEs 13 years ago, and we're now managing triple the assets that we were then. Please look at B number 3, distributions. It's important to note that multi-year growth from FY11 to FY23 has gone from $720 million per year to $1.28 billion per year in FY23. That is, in many of our minds, the most important thing we do, the distributions. Investment performance, B number 5, net of fees. You'll note the 3, 5, 7, and 10-year numbers of the NMS SIC total fund as compared to the land grant total fund. The land grant numbers, of course, reduced as a result of severance tax performance. Item C, council matters. You will see that we are very happy this morning to be welcoming Kurt Sommer, who is sitting next to me here in the conference room. Kurt has been confirmed and he has been oriented. Welcome, Kurt.
Thank you. Thank you.
For those of you who have not learned about Kurt's background, that is available on the website. Item D, operations. As of, I think, the 3rd of April, we will be welcoming a new systems analyst, legal analyst, Francesca Moratti. It always pays to take our time in hiring. And we did. Sometimes it's frustrating and we'd like to move it a little faster. We're very lucky that we waited and we have hired an outstanding person. We are anxious to have Francesca join us. You will recall that our legal assistant, Gordon Sellers, retired, and Francesca will be moving into his role as well as doing some other things. External relations. 2023 is the 50th anniversary of the creation of the Severance Tax Permanent Fund. I had a call last week with the legislator who co-sponsored the legislation to enact the Severance Tax Fund, John Bigby, and he was thrilled that we are celebrating the 50th anniversary of the fund. He has been very supportive of us as we have enacted new legislation to increase inflows to the severance tax fund over the years. Charlie will be reporting on legislative matters here in just a moment. And next month, we're going to hear from Dawn Iglesias. She will be explaining how oil and gas production and pricing projections can affect and likely will affect the permanent funds. Charlie?
Thank you. Thank you, Steve. Madam Chair, members of the council, on page 17 in your binder, there is a summary memo regarding the 2023 session and some of the outcomes, which were largely positive in their implications for the council and what we will be doing and what may come our way in the future. Running through the highlights of that memo, in House Bill 2, which is on the governor's desk, so there's still, line item veto potential on some of these things, but we feel fairly confident that a lot of this money listed here will come to us. That starts with $475 million, a one-time general fund appropriation to the Severance Tax Permanent Fund. There is another $100 million appropriation to the Water Trust Fund. As you might remember, that Water Trust Fund had been on a terminal path with about a 10% distribution rate. That is no longer a worry, assuming that money does end up in the WTF. There is a $58 million contribution to the Tobacco Settlement Permanent Fund. That is if the governor signs Senate Bill 178. That replaces some monies that were appropriated in previous years. But that also, there was legislation that removes the tobacco fund as a reserve fund of the state. That provides additional stability. It lets the council and Vince perhaps create a more optimal asset allocation and strategic plan for that fund. So we're excited about that as well. The Rural Libraries Endowment, there was actually a special appropriation of $15 million that we were initially unaware of. And so that fund is going to see a little bit of growth that'll double its size, more than. Other legislation that's worth mentioning, Senate Bill 26 has the potential to deliver in coming years hundreds of millions, if not billions of dollars to the severance tax permanent fund. There are some contingencies here. The price of oil goes down. That could change this outlook. If the legislature makes additional changes in the law in the future, that could change the outlook. But if not, if things stay as they currently are in the coming years, the first 3 years that this law is in effect, it could deliver $3.5 billion through the severance tax permanent fund. The legislature is looking to use the severance tax fund in ways they have not previously, making today dollars into tomorrow spending power. And so that's a very exciting thing, frankly. Senate Bill 378 was another bill that further guarantees a basic minimum distribution to the severance tax fund at $92 million over the next decade, every year. So that is very good as far as being able to grow the fund in years where investments don't work as we'd hoped. We already have a current distribution that goes through FY28 of 23 million. This triples that. And so again, more stability, more assets flowing into the severance tax permanent fund that creates greater distributions to the general fund out of the STPF every year. Very positive things for New Mexico. Lastly, there are two new funds that the legislature created in the endowment model. One is the Conservation Legacy Permanent Fund. $50 million in that fund was appropriated, and the council will be investing that in the coming years. That will feed a program fund that helps conserve nature and other natural resources here in New Mexico. House Bill 527 will shift some money that's currently elsewhere in the state, about $100 million in opioid settlements. That money should arrive in the next fiscal year, and there might be another 100 million or so that's expected. Those are two brand new funds. So the council will be up to 9 endowment or permanent funds that it oversees. Our scope keeps growing. A couple other bills that I just want to mention at the very end here. Senate Bill 382. This creates a biosciences fund to be managed by UNM. It's a co-investment fund, and they will be making venture investments out of that. They got a $25 million special appropriation. Similarly, the New Mexico Finance Authority and their venture program did receive another special appropriation. They have a $35 million VC program they are launching. They received another 15 million in appropriations. These are things that potentially impact, along with SSBCI. That's some money that the feds have forwarded to the Economic Development Department. These are very specific to New Mexico venture capital. And so in the space that we run our New Mexico PEAP program, there's some healthy competition. Other programs are out there. And so it's something for the council to be aware of as we move our New Mexico venture capital program forward. Madam Chair, if barring any questions, I'm glad to answer them if you have them. Otherwise, that's the end of my report.
Questions from council?
Madam Chair, it's Steve. If there are none, I just want to mention one more thing, if I may. If you would take a look at the dashboard, which you each have, particularly the bottom left-hand corner of the front page, the blue box annual land grant permanent fund inflows from the state land office. So the things that Charlie just mentioned are records for the state investment office, the state investment council. These contributions, these inflows, and these new funds are things that we have honestly never seen before. So we're thrilled to be able to manage these investments on behalf of the state. So if you will, please look at that blue box and look at the 2023 fiscal year to date bar at the far right. you will see that that is a high mark for the beginning of this fiscal year. In FY22, the average inflow for the land grant fund was about $158 million per month. For FY23, the average inflow year to date, that is through February, for the land grant fund is about $247 million per month. 158 as opposed to 247. The average for the last 2 months is a bit closer to about 203 million, but the inflows moderation in the latter part of this year will not negate the record total inflows to the land grant fund from the state land office. Thank you, Commissioner. And that is the end of my report.
Great, thank you, Steve. Madam Treasurer, do you have a question?
Good morning, Madam Chair. Good morning, everyone. Quick question on page 25, I believe, or is that going to be a different portion of the report? My basic,
that will be our performance report from RVK when we get to that agenda item.
okay. I think for me, my question would be to SIC staff. I know that the State Treasurer's Office sent over some money on January 3rd on the tax stabilization reserve and the early childhood funds, but it seems as though they might have not been invested until after February 1st. So I just wanted to know the process in which when we transfer over funds so that we can make sure that when we do transfer them, if there's a timing situation on the investing that we hold off. We originally thought we were sending them out February 1st, and then we're required to push out January 3rd. And so for the reason of investing and also to make sure we structure our liquidity, this is a good question for me to ask staff or whoever would like to answer.
Answer now. Sure, Madam Treasurer, thanks for your question. So we really can only buy units of our pools at the beginning of every month. So what I normally do our rebalance trade, last business day or the next to last business day, and submit that to our accounting folks. Then they work with the bank to get the units moved. So cash flows to us toward the end of the month will get invested quicker than cash flows to us at the beginning of the month. Typically, if we get cash flows, well, anytime during the month, it gets immediately invested in our cash pools. But to get into the longer term pools, the unitized pools, it can only happen on the first business day.
Thank you, sir. Thank you, Madam Chair.
Thank you, Madam Treasurer. Further questions? Okay, Vince, are you going to illuminate us on this current banking situation and how it impacts us in your CIO briefing?
I will do that exactly, Madam Land Commissioner, and thank you very much for that question. Normally, my briefing to you all every month just comes from the discussions we have in our strategy group meetings. We have two a week, so I usually look back over my notes, and that's the source of your brief. But thanks for raising a particular issue, and I built this month's briefing around that. I think it'd be constructive if we sort of go back in time a little bit and talk about some of the issues that have, or some of the factors that have created the issues that we're facing today. And some of those issues are inflation and big jumps in interest rates and a weak stock market. And then, of course, some of the more specific things, Credit Suisse and UBS and First Republic, Signature Bank, Silicon Valley Bank, all those things. If we look back and see what the basis are, I think it would be constructive. So I guess I'll start and say that 0% is not an interest rate. I guess technically it is. Technically it is. But in terms of in the construct of monetary policy or anything really outside of emergency monetary policy, interest rate or 0% is not a good choice. In the same vein, deficit spending at the government level, at federal government level in particular, is also not a good choice in the longer run. certainly in times of economic distress, deficit spending can be countercyclical and be of some help. But as a longer run policy, that's generally not one that winds up with good results. So, so with those two things offered, that's exactly the policies we had for 10 years in the last decade. So from around 2012 up through 2021. So for about a decade, well, for 7 years of that decade, we had interest rates, federal funds rates at 0%. 7 years, not just right after during and right after 08, 09, but for many years past that, the Fed held interest rates at 0%. I think the number for deficit spending is in last year's annual investment plan. I'm just pulling this from memory, but I believe the federal government here in the US spent from 2012 through 2021, deficit spent $16 trillion. That's roughly half of the debt that we have today at the federal government level was spent just in that decade through deficit spending. And this was not just here in the United States. This happened globally. So there were 0% interest rates, in fact, negative interest rates in Europe for some time over the last decade. And of course, European and some Asian governments also deficit spend. That's the foundation that's at least part of the foundation, a good part of the foundation of some of the issues that we're seeing today. So the failure of a couple of banks that we've seen here, certainly the levels of inflation that we have, the response that the Federal Reserve has had to that in cranking up interest rates, the weakness we had in the stock market in 2022. Those things have roots in those policies that we pursued over the last decade. So with that as a basis, Madam Chair, let me address the Credit Suisse issue. First, Credit Suisse is not the highest quality big bank in the world. They've had not only financial problems at the bank, but they've had management problems at the bank. It doesn't have the best reputation out there of the big global banks. So it's not a surprise that, when some pressure came into the system through these interest rate hikes of the Federal Reserve, that Credit Suisse was one of the banks that wound up with a problem. The Fed's taken a lot of criticism. If you read the Wall Street Journal or any of the financial news media, you can see how much criticism the Federal Reserve has taken because of the interest rate increases over the last year. We've actually been, positively oriented to what they've done. It has created an interest rate shock in the
Hey,
economy.
Vince, why? Why have we been positively oriented when
Inflation
that's not
is
sort of the narrative?
inflation is a horrible tax on people, and absolutely getting control of that had to have been the Fed's first has to have been the Fed's first objective. Inflation at the levels that we saw are very damaging to people generally and broadly to institutions. So the actions that the Fed took of raising interest rates up here to 5%, was the right move. I think it was done very quickly, and 5% is a long way from zero. So the Fed understood that they were going to create an interest rate shock, but apparently felt that's what was necessary to get inflation down. The Fed always beats inflation. They always win. When inflation gets out of control, they do get it under control. And that's just what they were doing. I think second, and from a longer term perspective, other than just simply beating inflation down, there needs to be an interest rate in the economy. Not every investment that can be made should be made. Not every project that can be constructed should be constructed. Not every business that is in business should maybe stay in business if they're not financially sound or other issues. So, and when you have a 0% interest rate environment, or even an interest rate environment that's too low, these things happen. We generally group them under the heading of moral hazard, where investments are made shouldn't be, and projects are done and maybe should not be. And a lot of that's created by too low of an interest rate. So So the Fed's activity is more than just beating down inflation. I think from a more positive standpoint, it's at least putting an interest rate in the economy. Now, it may be too high. There's an argument for that. We see that every day in the paper. But we're oriented toward that there should be an interest rate in the economy to stabilize investment markets and the economy generally. But back to our issues of Credit Suisse and UBS. Yeah, it wasn't a surprise. So when Silicon Valley Bank had its problems, the first thing investors do when that happens is, okay, who's next, right? That's the thought that comes into people's heads. And so we saw a couple other more regional banks start to have big withdrawals and questions around their financial stability. And then of course that's spread to some of the bigger banks, and Credit Suisse was probably the weakest of them. If you look at some of the measures that are used to determine the strength of a bank, and there's been plenty put in place from a regulatory basis since 0809. Probably the strongest big bank like CS is JP Morgan. Their stress tests and things come out among the best of banks. It's not coincident that that's our custodian bank, where a lot of our money sits is in, or a lot of the council's money sits is in JP Morgan. So it's not a surprise really that CS came out first with problems. The merger with UBS, that's just another big, or the other big Swiss bank. So between the Swiss central bank and the Swiss government and the management groups of those two banks, they merged into one big entity. It's a little frightening how big it is relative to the Swiss economy. I think they've got 15 trillion in total assets between the two banks. The Swiss economy is 800 billion a year. So it'd be very difficult to rescue something of that size by the Swiss bank with an economy that's tiny compared to total assets this bank holds. I think kind of to round out the discussion, Madam Chair, is just what's happening now. We expect to continue to happen, and you'll see more of this in the annual investment plan this year. We just think, we've talked about this last few meetings. We just think this kind of volatility, this kind of uncertainty, as we kind of switch from an economy that was fed free money and deficit spending by governments all over the world, as we switch from that to an economy that has an interest rate and probably is facing more fiscal policy tightening. We just think that these kind of things will be popping up as we go forward. So as a matter of what do we do about that? I think we've already done a lot about that, particularly since 2017 with our changes in asset allocation, and our investment team continues to comb through the portfolio, make sure that we have the highest quality managers, who in turn are buying the highest quality assets that we can have. And it's certainly been a big help to have the cash injection that we've had over the last year to keep us liquid and keep us in. A lot of that money goes first into the safest of securities, and then we move it into the risk markets. That's been a big help for our particular fund. So with that, that's a briefing. Have any discussion you'd like to have?
I'm sure there's going to be discussion, Vince, and I appreciate that overview. I see that Member Tejas has turned his camera on. Did you have a question?
Yeah, just a quick question. Could you let us know what the collateralization requirement is for our fund, for our bank funds?
The collaterals at JP Morgan in our cash accounts, or yeah, 100%. The cash account that we have there is all treasuries. There's no leverage, there's no securities lending, nothing. It's straight up short-term treasuries.
Well, I'm familiar with the state requirement for any of our state funds that are held in banks. You have to have them collateralized at about 50%. That's what I'm referring to.
I'll have to get that info for you. I don't know off the top of our head, what JPM's collateralization is.
So, Member Telles, so I think what you're might be referring to, and this is from, and maybe Treasurer Montoya can step in here as well, but I think what you're referring to are municipal funds that are placed on deposit at banks.
No.
That. Okay.
No, it's the actual bank balance has to be collateralized. I mean, in terms of state funds, and I don't know if the SIC qualifies for this, but 50% of at least 50% of the bank balance should be collateralized. Is that right, Brent? I mean, are you familiar with that?
Well, as I recall, and based upon activity that I've seen in the past, we don't keep anything at our agent bank. We generally transfer it over to JP Morgan, and the collateral requirements on the cash at JP Morgan is just as Vince outlined.
Oh, okay.
Madam Chair,
Madam Treasurer.
JPM is 50%, I believe, by statute. And for all of the New Mexico State Bank banks that we operate with, I just increased the collateralization to 100%. I already did get a couple phone calls from some of the lobbyists for the two different banking industry groups, but by statute, we are allowed to go between 103% and 50%. Class A counties can go up to that threshold, and any of the other counties, it's only 75%. They had a concern that me changing it to 100% would make other local governments decide to do the same thing. And I said, well, that's their prerogative. That's being prudent, especially in this volatile market. So I hope that also helps with the conversation. And I appreciate talking about Silicon Valley and risk assessment. And my question also would be, what is our risk assessment that we're evaluating based on the lessons we learned from Silicon Valley? Because a lot of the risk assessment parameters that we've looked at would have not seen what Silicon Valley was about to drop. So we're reevaluating that internally as well to make sure that some of the things that we see now from Silicon Valley are items that we can add to our risk assessment. Just wondered if SIC is doing the same.
I think, Madam Treasurer, the answer to your question is that's an ongoing process for us. In terms of our cash and our liquidity, as Brent pointed out, it's all at JPM, and we assess JPM to be one of the strongest, if not the strongest, of the big global banks. So I think it's an ongoing process, and that we go through.
So Vince, can you remind me when we take a look at our annual investment plan again?
So we'll deliver that to you, Commissioner, in June.
In June.
It was August last year. There was just some volatility and around a couple things, and I delayed it a couple months, but we'll get this one to you in June.
And I'm wondering, I know there's going to be discussion around that, and I'm wondering if materials will just be sent out in the normal, with the normal amount of time. Can we get that particular item with maybe a little bit more time to review?
We preview the annual investment plan with the investment committee the month before, so
Great.
Just to collect their thoughts and things. So you'll see a draft in May.
I think that's ideal. Yeah, to give us kind of a little bit of time with that. Great, perfect. Thank you.
Vince, just a couple of questions. One on impact on regulation. I think we will see more regulation, certainly back on stress testing for regionals, but also the impact on what I've been hearing is that the regionals and local banks are going to pull back, and it's so going to dry up. That's going to impact, and also on real estate because it's mostly local regional banks. So our investments, I think, are more global, but at the same time, what do you see happening on regulation and then regional bank loans?
Sure. Yeah. No. Good questions. Thank you. So the biggest reform that was done to banking regulation was in 2008, 2009 was the Dodd-Frank bill. Barney Frank, who was the sponsor of that bill, was a board member of SVB. So I think you are.
Irony there, yeah.
You are spot on. There's going to be some regulation change when the co-sponsor has his bank bill. So yes, we are looking at increased regulation. There's been some argument, and I've been able to see the point of a couple that have argued it strenuously that the regulators, it wasn't so much a problem with the regulation, it was a problem with the regulators. They just weren't on the ball in a couple of cases. I see that point, but it's still going to result in changes to regulation, not necessarily changes to just the regulators. In terms of broader effects on the economy, yeah, I completely agree with you. I mean, residential real estate would be the first thing that pops to mind that, could slow even further. And it's been slowing dramatically here just because of interest rate increases. I mean, new mortgage applications just fell through the floor. It's the lowest level we've seen since, I think, the 70s or something, or early 80s. So that's kind of the first thing. Our real estate portfolio is primarily big commercial properties that are financed outside of the banks, financed by people like us. And there is debt on almost all of those properties, and that debt does come from the banks, but they're very well capitalized, and they have people like, funds like us standing behind them in terms of financing. So in the types of properties there, Class A office space in New York City, or Class A properties in the biggest markets would be a good example of what we're currently holding.
And then a third question, the cryptocurrency crash and the relationship to this, and some of the arguments for cryptocurrencies is an alternative to government regulation. What do you see the tie between the two, or two disparate?
Yeah, I saw, can't remember the guy's name. He's a wealthy entrepreneur. He put up, somebody was talking down crypto, and he put up he said, I'll do this. I'll put up $1 million and you buy one Bitcoin, which is valued around $26,000 today, right? And in 90 days, you can have the bigger of the two accounts. So he thinks crypto is headed, this person anyway thinks crypto is headed much higher. There's a lot of controversy around cryptos and whether or not the government should start one of their own. There's been talk about that. In fact, even some testing around a digital currency that's sponsored by the government, not just a currency like the Bitcoin. So we'll keep our eye there. We've not made any investments. We've gotten that question: should we make those investments? I do know public funds that have. We're not first movers like that.
It's I don't know if you know Joanne Barefoot. She was the first woman deputy controller of the currency, but she has a conference here in Santa Fe every year called Smoke Tree, and she brings together I go to it every year, regulators, fintechs, VCs, regulators from around the world. And this last one was on cryptocurrency. And again, a lot of countries, mostly developing countries, central banks are starting to create stablecoin kinds of options. But to me, and Gary Gensler is trying to define it as more a investment vehicle, and the Fed is looking at it whether it should be a payments vehicle. And I think until I think it's not a good thing. But what is interesting, and my field's in the cybersecurity area, there are these intermediaries that have developed new businesses you never thought of, that they pay for, if you have a ransomware event and your company will not allow you to pay in or own Bitcoin or any kind of, you pay them in cash, then they pay the Bitcoin for the ransomware. And again, that's a highly speculative kind of thing. Some people holding the Bitcoin are taking a certain amount of money for what the payment is. But it's an interesting world. But I was saying last night, there was a webinar that was talking about questioning whether the crash in the cryptocurrency led to the crash of Silicon Valley Bank.
The technicals behind Silicon Valley Bank were, when banks get the deposits that they get, obviously they start making loans, but with excess capital, they typically, buy securities, and typically those are treasuries. And that's exactly what SVB did. It was part of the regulation in Dodd-Frank that allowed companies like SVB to set up or set aside some of their securities investments, treasuries, into accounts that were not marked to market. And so it was a just basically a buy and hold accounting process. And of course, when interest rates went up, they lost value. They weren't some particularly long treasuries. So when we've got quite a bit of cash, but you also know we have a bond strategy that we're only taking about 8 or 8.5 years of duration risk. These guys are out in some stuff at 15, 16, 17 and longer durations. So and of course the speed at which your price moves is higher at the longer durations, right, than the shorter duration. So these guys took some double-digit losses when interest rates went from basically 2% on the 10-year, 1.5% on the 10-year to 4%, and even more out on the longer end curve where they were. So they took some pretty big losses that did not have to be marked to market. But financial markets always sniff that kind of stuff out, and that's what happened. People became concerned that the bank wouldn't solve it.
Charlie Munger and Warren Buffett both said, I wouldn't give you $25 for all the Bitcoin in the world. So those are opinions. I kind of value those opinions a bit.
Well, I think it was also Buffett that said if Americans understood how the banking system worked, there would be a run on every bank in the country.
A lot of there'd be a run on mattresses is what there'd be.
Okay, well, thank you, Madam Chair, for the time.
All right, if there's no more questions for Vince, we can turn it over to RVK for the performance report.
Okay, great. Thank you, Madam Chair and Vince. Good morning, everyone. Today, we have just a January performance summary in your packet. The private market data is not yet available, of course, so we'll try to keep our comments brief here. I think we can start off on page 22 of the meeting materials, just to frame up the performance.
T.S., excuse me, please. Would everyone go to mute? Thank you.
All right. Thank you, Steve. I think I mentioned page 22 shows our capital markets overview. At this point, of course, we know that January was a good month overall. That continued on a good fourth quarter, with most asset classes adding to overall returns. You can see that in the bottom right corner table titled Market Performance for that month to date, MTD as the label, lots of positive numbers. You can see that equities at the top posted mid to high single digits, again, in large part driven by prospect of easing inflation, at least ticking down. It's no longer increasing. It's still high, well above where the Fed would like it to be and everyone else, but at least plateauing or slightly moving down. And that has, of course, led to some hopes that the Fed might be able to take their foot off the gas pedal. This turmoil in some banking institutions, that wouldn't sort of extend that to the entire banking institution, but some, I think, is gonna slow that ambition to some degree. And I think we already saw that last week with the Fed, of course, continuing to hike, although perhaps at a more moderate pace. Since then, since January, quite a bit has happened, as Vince mentioned, very volatile. We anticipate that that level will persist. Much of those gains have been given back, although we're still positive for the year. We're seeing some divergent performance across different styles, different regions, but broadly still positive, barely, but positive on the equities, and same with fixed income, up a couple percent or so. But again, the daily moves are pretty wild. So that is changing relatively frequently. Vince already touched on the higher rates and the problems that has caused, the history of that. I think while we didn't know when, most folks were aware that rates would likely move up. We really only had one way to go, given how low that they were and the impact that's having. That's obviously very visible for some of the banks and the headlines that we're seeing there. Although as we look at this, we tend to think that really these institutions just weren't positioned appropriately for an environment of rapidly rising interest rates, and of course didn't then also take the appropriate steps to mitigate some of those risks that were discussed. Again, it's not a default or a credit risk, it was more a liquidity risk given how they were positioned. But again, as I said, the Fed seems fairly resolute on bringing inflation down because it is very destructive, as Vince mentioned, not just to institutions, but to everyone else as a pretty substantial tax. And so bringing that down more in line with the longer term targets that are much closer to 2%, although there's some growing flexibility around that number, is still an effort that will require further diligence there. Vince already described Silicon Valley Bank and some of the others that were more idiosyncratic in nature. As we look at this at its core, we think it was an asset liability mismatch in terms of the assets on the book. Their deposits essentially doubled in a 2-year period. So it's a very unique situation, and weren't able to deploy those in profitable loans to generate a net interest margin, which is how banks generally make money. So this was more risk management, I think, as some of you had already described. And for the SIC, in terms of asset liability, we look at that frequently, collectively. And one of the major tools that I know you all have seen is the intergenerational equity analysis as a longer term gauge in terms of making sure that you have a good and appropriate match between your assets and your liability. And I think one of the benefits for a perpetual institution like the SIC is that you've got a much longer horizon than something like a banking institution where there could be a bank run. So we saw that play out obviously very publicly. The yield curve, just the last bit I'll touch on, that's in the top right corner of the page. That just indicates that the rates are meaningfully higher. Vince mentioned how much they moved up. You can see that visually. They were essentially at zero just a year or two ago and have moved up to around 5%. Very quickly, as quick as really we've seen in a number of decades. And that yield curve inversion has persisted for quite some time now. And as we've mentioned in prior meetings, has always been an indicator of some form of recession. So we'll keep an eye on that. In the interest of time, I'll pause here. Happy to take any questions or comments. Otherwise, we'll turn it over to Marcia for just a brief review of the fund performance.
Marcia?
And welcome to new council member Summer. Looking forward to meeting you in person. I'm going to ask you to go to page 24. And as you're doing that, just a reminder that performance for private equity, real estate, and real return assumes a 0% return in intra-quarter months. So that's why we call this a preliminary report. But if you go to page 24 at the bottom, you'll notice the month return for the month of January is 3.18. You can see outperformance through fiscal year to date versus your benchmark, and through the 1 year, slight underperformance 3 and 5, but longer term outperformance against your benchmark as well for the land grant. A little bit different story for the severance tax total fund, but positive return. And at that point, for the first month, you were at 3.18 on a calendar year to date basis. For the land, for the total fund for land grant, it was 3.56, and for severance tax, 3.03. Just quickly on page 25 and 26, this is looking at the asset allocation. Treasurer Montoya pointed out the cash, and Vince explained how that works for the unitization. That most of this money has been deployed in February, as Vince indicated. But that's just a timing issue for most of that money. With that, and we'll go to page, let's go to page 30 and 31, and I'll just say a couple of words about the composites. Again, your total fund for the month was up 3.18. A little bit different story for land grant and severance. Land grant doing much better. US equities outperform their benchmark. Remember, you have restructured that. You're going to perform very much in line with the index. The most of that is index, but in this case, your active managers actually added value for the month. On the non-US composite, you see some slight underperformance for the month, but the track record there longer term has historically been outperformance against your benchmark. Again, emerging markets for this period doing much better than developed. On core fixed income, something we don't see typically with your portfolio is some slight underperformance. Again, this was a month where having exposure short duration in treasuries was not. It was a bit of a headwind for the month, but that was only a month, and you can see strong outperformance longer term there as well. Same is true for non-core fixed income. And then if you go to page 31, I'll just make the comment again that, again, this is intra quarter month, and we don't have performance that's for private equity, real estate, or real return. The exception of that is a small allocation to financial real return, which is only 1.38% of the portfolio, and that is small allocation to MLPs and some mezzanine on debt, real estate debt. So with that, I only comment would be preliminarily in February, it's a negative 1.34 return for the month. Your composites looked good for the month, although negative, but relative to the benchmark, what we can see looks good with the exception of non-core fixed income. But again, this is all preliminary and down 1.34 for February. With that, Matthias and I'll take any questions that you might have.
So my connection went out in the middle of that.
Did anybody else's?
So did ours, Commissioner. We apologize for the problems we're having with technology this morning. Hopefully we'll be back in person soon.
Madam Chair, I had a few questions.
We'll go to Treasurer Montoya. So Marcia, just briefly, it cut out when you were on page 31. And so I don't know if you want to repeat the last little bit of what you said after the questions here, but
I'll just say that on page 31, it was not much because this is where we hold the returns at 0% on the months that are intra-quarter. So it's not reflecting returns for private equity, real estate, or real return.
Did you give any important info after that is actually my question.
No, we just.
Okay. All right, Madam Treasurer.
Oh, actually, I did. I'm sorry. I did give a preliminary that for the month of February on a very preliminary basis, you were down 1.34.
Okay, Madam Chair, Ms. Beard, my questions are on page 24. How do the land grant and the severance tax funds policy indices differ, and are the investment strategies similar?
You can see the allocations on page 24 at the top. Allocations are very, very similar. The difference lies in the private equity. You do have the state program in the severance tax, and you do not have that. You only have the national private equity program in the land grant.
Okay, and so then they are a little different. What do you attribute the underperformance for the last 10 years for the STPF?
A lot of that has been driven by the in-state private equity program.
Okay, and then my last question is on the footnotes. Performance, it shows gross of fees, but the composite is some gross, some net of fees. How does that distort the numbers? Or has anyone analyzed that or taken a look to see if it's significant?
Well, all of many of your, on the private side, that it's reported net of fees. On public, it's typically gross. So for example, on your private equity, that's reported as a net of fees return.
Thank you. Thank you, Madam Chair.
Thank you.
Maybe just one very quick addition in terms of the difference for on the 10-year or any time period driven between land grant and severance. You can see that on page 39, where we have the private equity returns. At the very top of the page there, you see the private equity composite. That's a 10-year return of 13.4%. And if you slide all the way to the bottom, it says severance tax state PE program. So that's specific to severance tax. Over that same time period, it's 3.2%. So that's a 10% annual differential that's driving that difference by and large.
And for the public investments, would it be pretty easy to post those net of fees? So that you can really have a similarity.
Later in the report, Treasurer Montoya, we do show net of fees performance later in the flash.
Page 41.
41.
Thank you so much.
Further questions? Hearing none, I'm going to turn it over to our chair of our investment committee.
Thank you, Madam Chair. I think my goal is never to rehash what you can read. I do want to call your attention to on page 51, under 1C, we spent a significant amount of time at the investment committee meeting talking about capital market assumptions. And you'll notice that those aren't included in today's agenda. Each of those assumptions will be cut. I think Vince made it very clear. Those will be coming up as the individual asset classes are covered and discussed. So the information was in the investment committee report documents. And if you're interested in reading that, you can. It's fairly long and fairly comprehensive, but we'll get a piece of that as we get to each asset class. So I want to make sure everybody realizes that. That's one of the reasons that the committee lasted as long as it did, because we covered that pretty thoroughly and extensively, but I think it's critically important for us. I think also I'd like to call your attention, Madam Chair, to number 3A. I'm sorry, 3B. If the council may remember, we covered this at the last meeting, and then it was Madam Treasurer asked that we postpone the decision on this until this meeting, so that there was a chance that she could become more familiar with the information and have more opportunity to discuss it. We agreed to that, and that's now before you today. So if you don't have any other questions, Madam Chair, we can move on to 3B and have Tom and his team bring that thing back again for us to vote.
Madam Chair, I have a few questions and comments.
At this time or after we hear from Mr. Lofton?
On this particular item.
Okay, Madam Treasurer.
On page 50, I noticed that there are only 2 committee members that attended this committee hearing or subcommittee. Can somebody tell me the makeup of who's on this board? How many members?
Actually, thank you, Madam Treasurer. I meant to bring that up. We did only have 2 members present. John Ulrich and I were there. The other 2 members weren't able to be there. And so all of these recommendations, if you talk about a quorum of things of that nature, it's Nick, Mike, John Ulrich, and me. Those are the 4 members of the investment committee at this point in time. And so John and I agreed with each of these investments, but there were only 2 of us there. And hopefully Steve and I have had a conversation about the possibility of adding 1 more person to the investment committee to give us a little bit more backbone in that particular committee based on potential absences. But that's where that stands. So that's who the committee is.
Madam Chair, Mr. Chairman, I did appreciate our conversation last week. In particular, I did speak to my staff, and I know I told this board that the investment committee meeting is during the same time as the State Board of Finance meeting. And so not to hold up these meetings, I asked my portfolio manager, who directly manages and invests, part of the 15 billion in my office, to attend this meeting. She attended by Zoom because, as you know, in the morning, that's when they're buying and selling. And I feel that my staff, when they're present, it's a reflection of myself. So if they're asking questions because I have questions, or they're going to be informing me on what they've learned in whatever committee hearing I tell them to go to. I appreciated that she was listened to, but I did not appreciate that she was not heard and not really given the time frame that needed to be for her to ask those questions. When I found out that there was only 2 members that were actually present, that was even more alarming to me, because for me, a subcommittee is a committee that is supposed to not be a rubber stamp, but instead a conversation that we can have that's thorough and thoughtful, and be able to include as many people in the conversation as possible. The meeting, my understanding, started off with the idea that it was a conversation that we all needed to have in discussion, and it seemed as though maybe she was a little bit dismissed, and I didn't appreciate that, because if I'm not there, when my staff's there, it's still as if you're treating me that way. And so I would appreciate that Chairman Lavender did state that we would change those meetings to a different time so more of us can participate in that meeting. And I'd be happy to participate directly so that I do not hold up these SIC council meetings to be able to ask the questions that I have. And there was one comment that was made that was a little concerning to me, in that one of the recommendations is that I have to go directly through Mr. Moise, which I wasn't aware of, and I will start to do that. But the other was that me being a constitutionally elected official didn't matter on this council, and that we're all one member, one vote. I don't look at it that way, but I do know that we all have one vote. My vote matters in the sense that it comes from the people, and I can't vote on things that I'm not familiar with or don't understand. And there is a learning curve. So I would just ask that everyone be patient with me, so that I can have the opportunity to really give back to this council the way everyone else does. Thank you, Madam Chair, for your indulgence.
Thank you. I appreciate that, Madam Treasurer. And certainly as someone who was a new member of this council for the first time in my, history of being an elected official 4 years ago, I appreciate the learning curve aspect. I felt like I was given ample time to be able to, keep my head above water during meetings. I don't even know that I can do that yet. And I've been on for 5 years, certainly not with the financial background that you come with either. But I think that request for patience and time for you to learn your role, I think is taken at least by myself. And, I want the members to have the support that they need in order to make the decisions, these very grave decisions that we have to make on behalf of the fund and the trust and the citizens. Member Messina, did you have a comment?
Yeah, I'm a little confused about something, and I wanted to meet with the gentleman about the benchmarks, but I became ill and I couldn't do it. However, my understanding was at the time that he made his presentation, he invited us to meet with him to discuss it. And I had the impression that meant we would contact him directly. So I'm not sure what the protocol is. And I certainly understand why the treasurer thought that was appropriate, because I would have done that, but for my health. So
I actually don't know what the protocol is either.
It would be helpful because, when we talked about hedge funds, the directive was to talk to Mr. Tom Lofton, and we did have a meeting afterwards, and it was really awesome. And then he was the presenter for the literal switch over on the investment portfolio that we all agreed as a committee, as a council, that we wanted to get more feedback and more information. And I did talk to Mr. Lofton then and schedule some time and had a really wonderful discussion with him and Mary Bates and Mr. William. But I didn't know there was a protocol that I needed to go through the executive director, which I will absolutely do. I just thought the executive director had given guidance to allow Mr. Lofton as the presenter to be able to educate me and teach me on the side. But this idea on the council came about from the last meeting because we held up something again. And so I said I'd be happy to go to those council meetings, but they keep occurring at the same time as the Board of Finance, which I don't think that it would be appropriate for me to tell the governor I can't attend her Board of Finance meeting.
So let's just see if we can't clear up a couple of things right here. And so I see that a number of you are in person. Steve, what is the protocol? If you need a briefing from someone on your staff, what is the protocol for that?
Thank you, Commissioner and Madam Treasurer. It is helpful to us in order to coordinate what is going on with our staff. If members of the council would kindly let me know that you are needing to contact a staff member, we are certainly more than willing to make that happen. But so that we can coordinate the multiple things that are going on in the office, it would be very much appreciated if you would at least copy me on whatever contacts you're having with our staff.
Okay, is that clear for members? Okay. And then the second thing is the time and date of the investment committee meeting. So Member Lavender, Chair Lavender, is that something that you can or you all have contemplated moving around?
Based on the treasurer's request, I've had a conversation about that. My opinion would be that we'll make sure with Steve and the staff, that the schedule would fit his staff. And if we can find a time, I would then need to know from the treasurer, based on the committee load she has, when she might have time freedom, and then we can certainly have a discussion about it. I'm perfectly comfortable with making a change in the time if it works for the staff and for the other committee members.
Well, as the chair of that committee, I appreciate you making that accommodation and flexibility.
Madam Chair.
Yes, Member Messina.
Well, it would seem to me that it is public when the Board of Finance meetings are scheduled. So it's something that we should take the initiative to avoid in the first instance with respect to that, because we know that the treasurer needs to go to those meetings.
Again, I'll be more than happy. I'll propose, Madam Chair, is that I'll have a conversation with Steve and his staff. But the first thing I need to do is since we're making this move, I would ask the treasurer that she provide me with some alternatives, some possibilities, and then we can take the discussion from there. I know that we changed from 2 weeks before the council meeting to 1 week before to accommodate the staff's needs. And I would obviously need to do that first. But once the treasurer lets me know when she has windows, we can then take it from that point and see what we can do. I'm more than comfortable to do that.
I think that would work. Thank you. So hearing no further discussion on this item, I'm going to turn it over to Mr. Lofton. Are you on?
Yes, Madam Chair, I am.
Oh, you're in person. Okay, thank you.
I'm in person.
3B.
So, so thanks for the opportunity to go back through this presentation today. First off, I do know that last month's presentation was relatively complex. I included a lot of information. Some would call it maybe I overshared a little. So it came across as relatively dense, and then we were very late in the agenda. So I'm going to attempt to address all of that with this month's presentation. Just to start off with, where this presentation actually is going to start on page 54. The specifics of the hedge fund recommendation is on 53. That was placed at the front by mistake, so I apologize for that. I'm not going to go into the Academy Award thank you speech this month, but I will say that this took a lot of time to put together, and there were a number of material contributing parties to this, both internally at SIC as well as both of the SIC's consultants, RVK and Makita. We do these just to set the table. We do these structure reviews every 3 years. This is my first chance since joining SIC to do a structure review. So with that, let's go to page 55. And we'll just go through 55 and 56 really quick. So first off, to set the stage, we are not addressing allocations in this presentation, not within fixed income's allocation within the SIC plan as a whole, nor individual allocations within fixed income. RVK and Vince's team of strategists, they need to know the structure before they can go through and set their target allocation based upon what's available in the structure. So today is focused solely on structure and policy. So really quick, what are the considerations? First on the agenda, the asset class role. What is the role of fixed income within a portfolio, a multi-asset class portfolio? How should it function? It's not standalone. Secondly, and there was a lot of discussion around this today, how do we improve the transparency and make each of the components, make their functions clearer to those who look at the naming conventions, look at what goes into them? And then are we designing the portfolio to really make subjective market calls, or are we designing a portfolio structure that's going to perform in all phases of the economic cycle? It's kind of an unknown unknowns type thing. I forget the Secretary of Defense that came up with that. But I go back to, there's been a lot of commentary about Silicon Valley Bank. If you go back and there's something like, I want to say maybe 25 analysts that followed Silicon Valley Bank. The news really started trickling out late Wednesday, early Thursday. If you go back to that Monday prior, out of the 25 analysts, there were 2 sells. Everybody else was either, and the majority were overweight or buys. At that point, there was even one rating that had it a single A rating. It was all investment grade across the board. So, how do we counter against those unknowns? The best way we can do it is really 2 ways. One, creating a highly diversified portfolio so that it essentially has something for everything. Diversification is the key. Secondly, is building in flexibility to react to episodic to various episodic events that occur. So highly diversified, but with flexibility. And then, how do we use SIC's attributes to be more efficient about what we do? And then finally, what's the best way to measure the efficiency of what we're doing? So those are really the considerations, one of the recommendations that you're going to see today. So if we flip to page 56, so these are the recommendations, and I reduced it down to 4 major recommendations that are really ones that we need. It's not just informational in nature. These are recommendations that we need the council's buy-in on. These are recommendations that affect policy. So the first one, we're reorganizing, or we want to reorganize the portfolio into public market strategies and private market strategies. I want to emphasize that this change by itself does not add or subtract any investments or exposures. We're merely moving things around. There was a lot that I showed you last time that it was going to affect, but there's no new exposures that are created by this regrouping. It does group the investments based upon their dominant characteristics. And in this case, public markets, how they're measured, how transparent they are. Private markets, once again, they're measured differently, they act differently. And so we want to group them based upon their primary characteristics, so that then it helps us measure how we're doing in each of those better going forward. Secondly, so in my discussion with Treasurer Montoya, outside of our regular meetings, this was a suggestion she had. She said, address public markets first and then private markets second. So the second recommendation, all of our individual pools have multiple strategies within them. The short duration, which is really a cash management pool, only has one strategy in it. So we're going to recommend that we add an option in there for Vince's team, which is a very liquid portion of the high yield market. Now, I want to emphasize that when we add this, it doesn't mean that all that money is going to go in there. It's going to be a risk adjusted portion based upon what Vince and his team deems appropriate at the time. That could be 1%, 2%, 10%, whatever. And then thirdly, we want to significantly reduce hedge fund vehicle exposures. Vehicle is an important word here. Well, there's two things. Number one, vehicle is an important word here. I want to emphasize hedge funds aren't an asset class. You can essentially conduct any strategy outside of a quote unquote hedge fund. You can short securities, trade whatever you want to do. Hedge fund vehicles, in my view, in staff's view, in Makita's view, because of their expensiveness, because of their transparency, they're just not right for what we want to do right now. We're not eliminating hedge funds as an option from policy. We're merely significantly reducing our exposure to them. We're actually not completely eliminating our exposure. There's still going to be 2 hedge fund exposures in the portfolio. They're just structured and priced in a way that we think are good for what we want to do in private credit going forward. And then finally, the fourth one, staff and our consultants, both Makita and RVK, believe that we can improve the performance measurement of our private market investments. And that's through changing that benchmark to a leverage loans based benchmark. So before I go through each one individually, are there any questions so far? Okay, so let's go to page 57 really quick. What set the stage for changing non-core to private market investments? First off, the private debt market has grown more than 6-fold since the great financial crisis. And secondly, SIC's quote unquote non-core portfolio has doubled. It's up 70% if you include unconstrained. And then SIC's private debt market pacing, meaning the new money that we want to put to work on an annual basis, that's doubled to 1.6 billion per year. So private markets, it's not non-core anymore. It's core for the rest of the world, and it's core for us. So it's, non-core implies for those that may, all stakeholders that may look at our portfolio, non-core implies something temporary. It's not temporary anymore. It's a permanent allocation going forward. So we want to essentially change things so that we can group like-kind investments together and not think of private market exposures as something that's temporary in nature. On page 58, let's talk about how that bleeds into the fixed income structure. So our current structure at the top, in the top left, core and non-core, we're simply moving to the right, or excuse me, to below that, public market strategies and private market strategies. And we're grouping those public market exposures together and those private credit exposures together. When you have them mixed, like we currently do in our non-core portfolio, where we have some public market exposure, we have some private credit exposure, we have some hedge fund exposure. When you think about it, public markets are measured with time-weighted returns. Private markets are measured in money-weighted returns. They generate their value. It's measured in two different ways. When you mix those two different ways of measuring them together, it obfuscates your ability as overseers to understand how they're performing and how they're performing relative to the market as a whole. And frankly, the job I'm doing, our peers do not utilize a combined structure. And importantly, you know, there's two different volatility patterns there. So once again, it just helps to understand how the portfolio is performing and how we're doing our job to split those apart and put eggs in one basket and oranges in the other basket, as opposed to mixing them together. That's an awful metaphor, but it's all I could think of at the moment. So are there any questions on this part, on the fixed income structure?
Madam Chair, John Bingaman here.
Member Bingaman.
It's just one question or comment maybe, but you know, I think the way that we've historically done it with the core, you know, one nice aspect of that as a council member is, you know, I think it's an easy way for us to look at that. And, you know, those investments have always been sort of super safe, right? Treasuries and very high grade corporate bonds. And I think that's what I've always thought of as core. Sort of like in real estate, you have core and then you have core plus or opportunistic. You know, core to me implied not so much that it was a permanent part of the portfolio, but just that it was a very safe, you know, highly liquid part of the portfolio. And so if I gather correctly, what you're doing now is you're sort of moving high yield bonds, you know, effectively into that and calling it public markets. But high yield, you know, doesn't have those same, you know, safety characteristics that treasuries and high grade corporate bonds have. So could you speak to that in terms of, you know, how can we as council members, you know, quickly assess under this new structure, you know, what the kind of quote unquote safe liquid part of the portfolio is that we used to just be able to look at our cash and our core fixed income to represent that?
It's a good question, and it really underscores the fact that these exposures have always been in the portfolio as a whole. So let's go, if you don't mind, let's flip to page 66 here. And it's titled Structure Comparison and Strategy Migration. So as part of this, well, first off, on the left side, you have the current structure that we're under, and you'll see it going from left to right. We have the two allocations, core and non-core. And then within those allocations, we have accounting pools. And these pools are where the participants buy into or participate in SIC, whether it be the city of Rio Grande, any one of the permanent funds or whatever. You can, let's say you want exposure within the core allocation to the core bonds pool, you buy X number of units there, or if you want core plus, you buy X number of units there. So in an effort to improve sort of clarity and understanding as what's driving the underlying performance, and to your point, you know, where does the credit risk take a step up from being safe to greater risk? Part of the changes that we're going to make is you move from, on the left side, the core allocations, to the right side, the public market strategies. We're going to change the pool name from core for those investment. So core is going to be, just like you said, it's a combination of treasuries, investment grade exposures. The next one down is credit plus. We're going to change it from core plus to credit plus. So if I'm a local government and I'm looking at these two pools, and I'm thinking about which one I should go to, with that subtle name change, that gives me an idea. Hey, this one's greater credit risk. And if you look at within the core allocation that we currently have, that core plus accounting pool, that already has high yield in there. It's longer duration high yield, which is actually greater risk than the shorter duration that will be moving from the non-core into the public markets. But that high yield is already there. It's already there in core. It's actually longer term, and by moving this shorter duration high yield that's in non-core now into that pool, it actually reduces that risk because it brings that duration of that pool down. So I see your point. Part of the underlying changes that we're going to make, and this is some of the minutia that I got into last time, is changing these names so that people can see through and kind of get an idea immediately from the name, hey, this one's higher credit risk than the other. But also, yeah, those high yield exposures were already there within core. We're just grouping them. We're grouping all the high yields together now. Does that answer your question, or does that help?
No, I think that does. Yeah. And I think I probably hadn't focused enough. The fact that we already had some high yield there in the core allocation. I got to say, I don't think I really agree with calling that core if it is high yield, but I understand much better now. Thanks.
Madam Chair, could I make a comment?
Yeah.
Thank you. Member Bingaman, yeah, you know, that high yield strategy that's in there is a short duration strategy. Tom mentioned his presentation about the duration. It's short duration. So those securities that are in there typically have less than a year to maturity, and a duration of the portfolio is, I don't know, something under 9 months probably. So while they're technically, high yield securities or, below investment grade issuances, they're all within a year of maturity. The reason that was put in there in the first place is interest rates have come down so far, and investors typically have core bond allocations in their portfolios for three reasons. One's to generate income. One's because core bonds, and you hit the nail on the head in terms of what those are. It's treasuries, high grade mortgages, and high grade corporate bonds. Typically, that has a negative correlation with our equity portfolio. So when stocks are down, our bonds are up, and vice versa. And then for liquidity purposes. So as interest rates came down so low, the bond portfolio stopped doing all three of those things. So it wasn't generating much in income, with interest rates at 2% on the 10-year. The negative correlation to equities really shrank because when you have, say, a 6% or 6.75% yield on the 10 years, we did back in 2000, and stocks fall out of bed, the 10-year fell to 4%. We had double-digit gains in our bond portfolios. At 2%, the 10-year falls to 1%. We don't get those double-digit gains, so it was much less of an offset to our equity portfolio. And then third, liquidity has dried up across the bond stack, except for treasuries are still quite liquid. So it required us to make some changes to the portfolio to try to get as much of those three things back out of it. And that high yield, short duration, high yield portfolio is really a liquidity portfolio, because if we just tell the manager to wind it down as maturities come in, that the portfolio is relatively safe because of its short duration, and it kind of feeds its liquidity as we move forward. So I think what Tom's done here does make it a little more clear, and it also does allow longer duration in the portfolio, but it's in that credit plus bucket that we can either own or not in any individual fund.
Member Bingaman?
Oh, thanks, Madam Chair, and thanks, Vince. That makes sense, and I think hopefully we can discuss, when we review the investment strategy report, whether it makes sense to, maybe de-emphasize high yield now that interest rates are up and we can get some decent yield, and maybe traditional core fixed income can play that role now again. We can maybe reallocate some of the investments into high yield into some more of the private market strategies. But thanks for that information.
All right, thank you. So are there any more questions on the reorganization to public markets, private markets allocations? Okay, so
So,
next one would be
excuse
for
me,
the, I'm sorry.
I
Sorry,
have a
Mr.
question.
Lofton, we do have an additional question. Member Messina.
Thank you, Madam Chair. Can you tell me if this has an impact on the council making investment decisions? Or is this just to give us a better picture of what's going on?
Both. If you have a better picture of what's going on, then it helps inform your oversight of what we're doing and what future investments or reallocations we're going to make. I mean, that's the whole goal here, is to improve, frankly, transparency for oversight. It's going to make it easier for us to ask better questions when we're regarding our performance, because we're going to be comparing like kind investments based upon their major characteristics.
Madam Chair and Member Messina, these structure studies are really important to the process because there's so many stakeholders in how these portfolios are structured. So Tom mentioned from the strategy group perspective, when we're setting asset allocations, we have to know what these asset classes are the building blocks, and we have to have good confidence that we know how they'll act over time. The asset class directors need a structure for each of the asset classes so they can properly address all the markets. Brent's group, the accounting group, needs to have a structure that they can account for the investments within them and report. And then the council and our management group need to have a clear idea of how we're addressing the markets through these things. So that's why we emphasize them and hit them pretty hard with you guys in these meetings, and we try to address them about once every 3 years.
Thank you. Thank you, Tom and Vince.
Sure, absolutely.
Mr. Loughlin, continue.
So, I'm sorry, are there any more? Well, in that case, let's go quickly to the short duration pool. Similar line of thinking in that we want to give Vince's team an additional option in the short duration pool. We want the ability to add a highly liquid high yield strategy that would complement the existing investment grade focus strategy. And once again, this is just an additional option to that Vince's team, it's additional lever within that short duration pool for them to allocate as they tactically see appropriate. And it's not, there could be any allocation in there. It could be 0% all the way up to whatever percent. And when we, when we present we'll have to present the strategy to the council. And we'll also, at that time, we'll detail the constraints that we'll put on that strategy to ensure that it's a highly liquid strategy.
Madam Chair, Mr. Lofton, are you on page 58? Or did you go back to your presentation, or?
I apologize. I'm on page 59.
I think your page 58 is really important for those that didn't get to talk to you separate.
And as Treasurer Montoya, as you probably learned, I love to talk. So if we go through Steve and I'm happy to go into detail with all this as members need, as council members need. So if there's no question on the short duration pool, we'll go to the last one, or excuse me, we'll go to hedge funds really quick. And then we'll talk about the benchmark. So hedge funds, as we said before, we're on page 60. As we said before, they're generally not a fit within SIC's fixed income at this time. And I want to reemphasize two things. One, at this time. Two, vehicles. SIC does not need the liquidity that's provided by hedge funds. Hedge funds tend to be expensive relative to private credit funds. That's primarily because they need to provide that liquidity as part of their structure. Private credit funds typically have better investor, limited partner, or manager alignment and manager alignment. And I can, I'm happy to go offline and kind of get into that, how they earn their returns over time. But there's better alignment in traditional private credit funds. Private credit strategies typically offer better transparency. And one of our key goals, these changes is to improve transparency. As I've said before, hedge funds are structured. They're not an asset class. You can do every strategy that we want in a hedge fund. You can do that in a private credit structure as well. And then finally, hedge fund performance is typically measured in time weighted, like public returns, while private credit is typically measured in money weighted IRR returns. And mixing those together makes it more difficult to understand the performance, how the performance was generated. Are there any questions? Okay, we're on to the final one, page 61. Which once if we reorganize public-private, the benchmark for the private strategies portion of the portfolio, and that it should change. So the legacy of the current non-core benchmark, it reflects SIC as an initial foray into the non-public markets. And as you can see there, it's a mix of public market exposure. And it's also a mix of, got about high 50% of hedge fund index exposures. And we can talk about why hedge funds were kind of appropriate for our initial foray into non-public markets. They provided that liquidity as we were testing their toes. But since we started, the private credit markets have matured tremendously and grown tremendously. So the proposed benchmark is Credit Suisse. That's a bad name right now, but they're the ones that they're the ones that are maintaining this benchmark at this time. The Credit Suisse Leveraged Loan Index plus 2%. It is consistent with our peer universe. It's transparent. It's an index of syndicated bank loans with active secondary markets. So we can see what drove the returns. We can look under the hood. So leverage loans can be, they're essentially viewed as a bridge asset class between the fully public and the private markets. So it's kind of that last line before we go private. And we say, look, if we're going to go into the private markets, what additional return do we need to garner to justify that? And that's where the plus 2% is. And then finally, leverage loans, they have floating rate coupons, which provide a better structural match with our private credit exposures, which tend to be almost completely floating rate themselves.
So we started the beginning of the meeting with Vince saying that Credit Suisse is not the most stable of banks, which is something that I didn't even realize until he had said that. So we've seen so to your point. So if you look at the Bloomberg indexes now, which we use the Bloomberg Ag. And we use the Bloomberg Universal in our public market strategies. Those started out with Lehman, then they went that failed, and then they went to Barclays that went away, and now they're the Bloomberg Barclays index. So the same thing is going to happen with this Credit Suisse index. It's probably going to transition to the UBS Leveraged Loan Index, and I worked in the capital markets. For about 15 years, and I never applied for a new job, but I was bought and sold many times, and so I know how the Credit Suisse feel. So it's we are using this. We think it's the best index because it has the most complete. It's also wonderfully transparent. So, but that's who's sponsoring it at the time.
Madam Chair, Credit Suisse is now UBS, and we have a great deal more confidence in UBS.
Right.
Yeah.
Madam Chair, a couple of questions. One, first, thank you for this because it's much simpler and easier to understand.
Understood.
I
Yeah.
like the way that you put it together. Thank you. So how is this compared to other state investment houses? Were they already doing this? Are they moving in this direction? How does it compare to our peers?
So and Mary Bates, are you on right now? Yeah.
Yes, I am.
Mary, so both Makita and it should be pointed out that both Makita and RVK came. So I didn't say we want this index. I asked them both, go out and find the right index for us. They both came back and said, this is a good index in the peer universe. And Mary is, this is what she does for a living. So Mary, can you speak to a little bit to what the universe of private credit investors predominantly, what they use for benchmarks?
Actually, I didn't mean just the benchmark. I mean the whole program, the shift.
Yeah, Madam Chair and Member Ellen, yeah, historically, public funds, had very broad portfolios, and they just call them core bonds, right? So, but as interest rates came down, and those three factors that we talked about earlier, stopped working or stopped being as good as they were in the past. Typically, our peers have split the portfolio into a core bonds portfolio that's much as Member Bingaman described, very safe and so forth, and then a non-core, or in our case, private markets, which is where the non-core type investments reside. Then they push duration of the core bonds portfolio out to try to pick up more, negative correlation for their equities. That worked pretty well when interest rates were falling, but now that that's done, that's starting to change again. So we've done the same thing here. We've split out our core portfolios primarily in the public traded markets, our non-core in the private markets. So we look a lot like our peers do. Probably the biggest difference is we just own less of it. So we own 10% is our current allocation in our growth portfolios. Our peers are probably more 15, even 20%.
And Mary, can you just quickly speak to sort of when you go out and look at the peer universe, what percentage would you say uses leverage loans as their benchmark?
Yeah, if the question is with respect to the proposed benchmark of bank loans plus an illiquidity premium, that is the industry standard. So
Well, are there any other questions?
I have a question for you. Can you explain, thank you, Madam Chair. Can you explain the 2% premium? Is that enough, or how you came across the 2%?
Yeah, it's a good question, and I'm gonna ask Mary to help out here as well, because that was something I leaned on for both Makita and RVK to understand what was the appropriate additional premium for us. And I will say one thing: we could have potentially gone higher, but there's as I mentioned to Garrett, that your consultant that we brought in on our call. So benchmarks can really, if you're a portfolio manager, and I've managed bond portfolios, benchmarks can affect you in a couple different ways. You want them to challenge you to beat the market. So you want to justify why you're getting paid to manage the money that you're getting paid. Otherwise, go index. But secondly, if you have a benchmark that's too high, it pushes you into too much risk to beat that benchmark. And my first consideration that I put at the top was fixed income's role within a multi-asset class portfolio. We have a group of assets, primarily fixed income offsets equity risk. Now, I personally I'm pro equity. I think if you have a basket of risk-seeking assets over the longest time period, they're going to get their greatest return in equity, right? So fixed income's role is to support equity. And given SIC's current situation as far as its cash flows, Fixed income's role in this environment in a multi-asset portfolio, and given our current positive cash flows, fixed income's role is to be a ballast and to be a point of safety. So we do want to maximize returns within a risk-adjusted framework. So why didn't we go with 3%? Well, we could have, but I want to have the flexibility to, at the fund level, take, not be overly pushed to take on extra leverage at the fund level as we go through each of our private credit funds. I want to be able to go more core. There, I use the word core, more mainstream strategies as a predominant part of the portfolio, so that although we're seeking the best risk-adjusted returns, they are risk-adjusted within the framework of our other exposures. And it does allow us that flexibility, or that ability to be more of to beat our benchmark, but at the same time, being less risky relative to everything else that's in the plan. So that's a long theoretical way of explaining it. Now, Mary, if you want to,
Yeah, I'd be happy
in
just
here.
to jump in and quickly address. So Secretary Montoya, we're happy to provide the support for this. It actually was in the earlier presentation, but the 2% ties to the historical observed premium from bank loans to middle market direct lending.
Thank you. And when was the last time we revisited the benchmark?
That is a great question. I know
Vince
that
may
it's
know.
not been. Yeah, Vince had stepped out. The last structure study was 3 years ago.
Matthias knows.
Oh, Matthias.
Yeah, we did a comprehensive review of all of the asset class benchmarks, including the total fund benchmark, as recent as I think January 2020, with the exception of real estate and real return, because those were pending upcoming structure studies such as this. So they've been reviewed recently, and one of the things that we did for most of the asset classes was develop a shorter and longer term benchmark, especially for some of these private asset classes, because there are some differences, and there's no perfect benchmark, certainly not for this. We would agree with everything that's been said on this. The 2% essentially being an illiquidity premium. It's not an alpha premium. On top of that, it's just saying for the sheer virtue of locking up capital, there should be some additional return, and that's where that's generated. But recognizing that over shorter time periods, you may have some divergence from the benchmark. So these are longer term benchmarks anytime you see a base reference plus a premium.
I ask because I think the benchmark is really important in the conversation that we had with Mr. Lofton and Mary. Was important to know that if we go too high, then you're pulling too hard to get that benchmark matched, and that could potentially create more risk. So I'm happy that Mr. Lofton had mentioned that too. I had one or two more questions on the high liquidity, high yield index. So single B to double B, that means, right, our junk bonds, low investment grade. So when we say that they're very liquid in times of high stress, sometimes those liquid buckets aren't as liquid as we think they are, or they might not have as much of a good price in that time frame. What's your thoughts on that perspective as it relates to the benchmark?
So it's a really good question. So the private market strategies would not be the private market strategies would not be a source of liquidity. That is the purpose of the public market strategies. That's where our liquidity would come from. And those would not be heavily dominated, really have essentially de minimis exposure to leverage loans, or anything beyond leverage loans. So that's what that 2% signifies. If we're going to give up that liquidity, then we need to at least make 2% above what leverage loans are going to make. But it doesn't imply that we're going to be out there investing in leverage loans. If we're in a market that is really stressed, and that we may, on the margin, we may pull out of our private credit structures and more into leverage loans as a liquid near private market. But that leverage loans, they're essentially a bridge asset class between public and private. And they say in our benchmark says if you're going to go beyond that, you need to get paid at least 2% more than what leverage loans do.
So then I think I'm talking more about the liquidity on the public side to Member Bingaman's point, being that is supposed to be more of like the safer liquid side of it. And we're changing the core plus to the core credit plus, which does mean the higher yield. That same question, how does that apply? Because I know sometimes we say things are very liquid, but when times are tough, pandemics, market crash, whatever the case may be, we've all been through the different scenarios. How liquid is it really is my question when we're looking at that.
Madam Chair and Madam Treasurer, the liquidity from the low duration high yield portfolio does not come from our ability to sell those securities. It comes from maturity of those securities. So almost all the securities have less than a year to go to mature, and the portfolio as a whole is something under 9 months in duration. And when debt at corporations gets that close to maturing, they already have plans, for replacing it. So whether it's a new issuance or they replace it with bank loans or, what have you. So those things mature and we get par a lot in that portfolio. So that's the source of liquidity is the maturities, not the marketability of the securities.
So if there's no more questions, I'm going to take us to page 62 on the recommendation summary. And I'll just quickly go through them. Staff recommendation summaries are: reorganize fixed income portfolio allocations to public market strategies and private market strategies. Add highly liquid short-term high yield strategy to short duration pool to complement the short duration investment grade strategy. Reduce hedge fund vehicle exposures as detailed in the accompanying memo. It was at the very first page of this presentation. Change benchmark to private market strategies allocation to the Credit Suisse leverage loan index with a 3-month lag plus 200 basis points. And those are the 4 recommendations.
Right. Hearing those, do we have a motion?
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Makila, SIC staff in general, fiduciary oversight of RBK, I move the State Investment Council approve the fixed income structure study and portfolio recommendations as set forth in the meeting materials and discussed by the Council today.
A second, Alan.
You've got a proper motion and a second. So motion by Member Lavender, second by Member Allen. Any discussion on the motion before the Council?
I just have one more question, Madam Chair.
Madam Treasurer.
If this is something that's too nerdy, we can talk about it offsite. But so we have high yield US Treasuries, investment grade, and short and long durations for each. The benchmark is investment grade and has an intermediate term duration. Do we look at the total duration of the investments versus the benchmark duration and adjust, or do we follow the total portfolio in terms of credit risk versus the benchmark?
Sure. So those are more or less tactical questions. So in creating this structure, it was to create a broad set of essentially levers, a broad set of a way to diversify the entire portfolio across, whether it be duration, credit risk, industries, whatever, to be able to create a broad diversified structure so that 2 things could happen. One, for those individual strategies within the pool, Vince and his team could tactically adjust the allocations among those. And then each of those strategies underneath are are actively managed by the individual managers. They're the ones that are going to make those decisions to either lengthen or shorten duration based on what their mandate is. Does that answer your question?
Thank you, and thank you, Madam Chair.
Great. So hearing no further discussion, we're going to take a roll call vote on the motion before us.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
Yes.
Secretary Props,
Yes.
Mr. Lavender,
Yes.
Mr. Summer,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Ms. Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 9-0.
Thank you very much. And just before we move on to the next agenda item, I wanted to say a couple of words. So first of all, I have you all pinned to my screen, so now I can see when someone has stepped out. Apologize for calling on you when you were gone, Vince. But also, and I can see Member Summer, and welcome, sir. But I just have sort of a request / recommendation that when we have these larger policy votes before us, so the annual investment strategy is a perfect example of that. Although I don't know that we vote to accept that. We do. Okay. Giving it to us a month ahead of when you'd like the action, I think, is kind of ideal. And so if, as you're planning these, bringing these items before the council, I think that probably I would recommend and request that to the extent that we can, those get brought before council in the meeting a month prior to when you would like the action taken.
Madam Chair.
I don't know who that is.
This is Nick.
Oh, Member Tess.
Yeah. Would it be a good idea? I mean, just for conversation purposes, maybe we get 3 shots at it. And I don't want to belabor things, and I know things need to be timely, but on these kind of more policy related structure studies and investment, more policy aspects of our role on the council. Could we maybe, I mean, I'd just like to hear thoughts on giving us the opportunity to have about 3 shots at it. A lot of times, you know, as you go through, you know, like the legislative process, things have to get through 3rd reading, right? And I don't want to have to bring that to this council, but, you know, these things are very complicated, as, you know, we've learned through the recent conversations. But even 2 months seems like we still are drinking from the fire hose in many ways. And so just, I want to throw that out there that, you know, on major policy restructures and investment policy restructure, things like that, maybe we get 3 shots at it. Just like.
So I think what we'll do, Member Tejas, just considering, you know, what happened with this particular vote and the fact that we do have the investment committee, not for folks to forget, we still have that opportunity. That is really 3 opportunities. If you attend the investment committee, if you attend the council where the materials are not only covered but provided prior to an action, and then attend the council meeting where an action is taken, that provides 3 opportunities to cover the material. And Evan wants to say something.
I was just stretching. I apologize.
Oh, sorry.
Madam Chair, may I make a
comment? I have this screen pinned because I can watch your every move.
May I make a comment, please?
Madam Treasurer.
I agree with both of you. For me, in this council, the investment policy, benchmark construction, and asset allocation are the most important fundamental aspects of all the other work that we as a council are doing, and also gives the guidance, the protection, the safety, and the statutory responsibilities of safety, liquidity, and yield to us. So for me, I got a little bit of extra assistance from Mr. Lofton and Mary Bates, and that it was really helpful for me. And so I would say, when you guys start thinking about any policy changes, if you can start to give us a heads up so we could start researching it. We don't want to stop you from doing what you need to do, but we really do need to be educated and informed on all the detail, because it really is the fundamental aspect of what we all are doing here. Thank you.
Okay, so I think what I would like to recommend is that we have those items on the agenda a month before action is required, but if folks might need extra time, if you could give us a heads up and we could make those requests as we individually need to make them.
Madam Chair, just if I could, just two comments. First, thank you very much for the focus on these items. You're absolutely correct that our asset allocation and the structure of the asset classes is highly important to generate our rates of return. And second, there's rarely time constraints with these type of items. We can get on track, if we don't move a specific investment through under a certain time frame, but asset class studies, asset allocation studies, those things rarely is their time constraint.
That's refreshing. Thank you.
Madam Chair?
Member Messina.
Yeah, I'm not in favor of changing our approach to these things, particularly in view of the many times that it's addressed in our current structure, and more importantly, the availability and willingness of staff to meet and communicate with members of the council to clarify things. We have the ability to get enough understanding without changing our procedures overall.
Thank you, Member Messina. Anything further before we move on to agenda item 3C, which is the first of our investment recommendations, and I'll turn it over to Mr. Lofton.
Thank you, Madam Chair. So as you said, agenda item 3C, we're going to start on page 190 of your handout, and it's titled Fixed Income Ares Pathfinder 2. This is a strategy that I am really excited to bring to the council. It offers a broad opportunity set managed by a deep and knowledgeable team. And importantly, it brings diversification of fixed income in several ways. The Pathfinder strategy targets collateralized investments in large, diversified pools of assets that generate contractual cash flows. The common feature of the exposures is really being that the investments are directly collateralized through contracts or physical assets. Joining me on this presentation from Akita are Mary Bates and her team. And then beside me, they were nice enough to come out here in person from the manager, Ares. I have Avi Gandhi. She's managing director and SIC's primary point of contact for the Pathfinder strategy. And then we have Joel Holsinger. He's a partner with Ares. He's also co-head of alternative credit. He's also the senior portfolio manager on the Pathfinder strategy, along with Keith Ashton. So in the staff memo that you have before you, you're going to find a description of the strategy, why staff likes the strategy's key strengths and weaknesses from staff's viewpoint. But for presentation's sake, I'm just going to focus on the strategy's fit within the portfolio. Nikita and Mary Bates, she's going to cover the characteristics of the strategy and the manager, which is Ares. And finally, we have Mr. Holsinger here to follow up and be available for any questions if you should have. So portfolio fit. The key, the private market portfolio is below target to asset-based investment strategies. So this will help in that respect. Secondly, diversification. So there's three levels for diversification here. Number one, with the collateralization. Collateralization aspect of Pathfinder's investments differentiate it from unsecured, what we're going to call general corporate loans or obligations that are backed by a promise to repay at the corporate level. These are collateralized obligations. Second is the opportunity set. It's a broad opportunity set, which allows for broad diversification across geographies, industries, and underlying economic drivers. Just a sample: auto loans, shipping containers, receivables, supermarket, rental units, quite a broad opportunity set. And then finally, cash flows. So as opposed to corporate loans, corporate obligations, where principal is often repaid at maturity, the Pathfinder strategy targets investments that exhibit principal amortization, kind of like your mortgage. On month one, you're going to start paying down that principal. We're not going to wait until year 3 or year 5 to get that principal paid off. And then thirdly, on the portfolio fit would be the structure of this vehicle. So ability to recycle capital. In other words, keep our capital invested. It's a structural characteristic that staff is prioritizing along with Makita. Pathfinder 2 allows each limited partner and unlimited 2-year extensions so that we can keep our capital recycled and keep it invested. So Pathfinder 2 is seeking to deliver 11 to 15% net IRR returns with a 1.5 to 1.75 net multiple on investment capital. That means our investment capital that we're going to, not only are we going to have a targeted return, but we're also thinking about, well, what's the dollar amount of what we're getting back? We're going to get back 1.5 to 1.75% targeted of our original capital that we put in. So staff in consultation with Makita recommends a commitment of up to $300 million to Ares Pathfinder 2 fund. I'll also quickly note, and honestly, we'll find the page, but our terms are in your packet, the terms that Ares is providing us for this vehicle. That information is non-public. It is in your packet, but just wanted to let you know that if you want to discuss terms, those specific terms that Ares has given us, those are non-public terms. So with that, I'm going to turn it over to Mary.
Great. Thanks so much, Director Lofton. I'm going to keep my comments brief so you can hear directly from the manager. But if you'd like to refer to your packet, the Makita memo begins on page 93. As Director Lofton has already referenced, the Ares Pathfinder 2 is an asset-based private credit strategy focused on directly originated investments and diversified asset purchases. The strategy targets a net IRR of 11 to 15% with a 1.5 to 1.75 net multiple on invested capital, with a quarterly distribution of 5% on an annual basis. Ares invests across a broad range of assets, including loans and leases backed by hard and soft assets such as heavy equipment and sports and media assets, as well as receivables and royalties. In terms of implementation, Ares employs multiple approaches, including lending against assets, acquiring portfolios and pools of assets, and opportunistically investing in liquid credit. The fund expects to be diversified across 30 to 50 investments with thousands of underlying obligors. Many of the assets will self-liquidate and are expected to generate a cash-on-cash return of approximately 10%, with additional upside through capital appreciation. The fund is expected to focus on North America with the ability to invest up to 40% in Europe. No fund level leverage will be utilized, although a subscription line will be used to bridge capital calls. The weighted average life of the underlying positions ranges from 2 to 6 years. The manager expects to be fully deployed within 18 to 24 months of the fund's launch and expects to recycle 50% of commitments. As of the end of last year, December 31st, 2022, Ares Pathfinder 1, so the preceding fund in this vintage, had committed $4 billion across 43 investments and was generating a net IRR of 15.9%, so in line with the expectations of the fund. That fund, Fund 1, had generated $1.2 billion in realized proceeds, which largely speaks to the cash-on-cash return of the fund meeting expectations. Of the 40 unrealized investments, 38 are exceeding or meeting their original underwritten base case returns. Transitioning to the strengths of this offering from Makita's perspective, Director Lofton has already alluded to the depth and breadth of this strategy, having met with nearly all of the asset-based lending strategies in the marketplace. We think that this is arguably the broadest strategy in the industry. The underlying strategies have limited correlation. They're very diversified at the asset level. Again, as already mentioned, consisting of thousands of underlying obligor. You have diversification from the industry, from the instrument perspective, with first lien loans, revolvers, potentially preferred equity, as well as diversification from an asset as well as an implementation perspective. Perhaps even more notable is the cash flow profile of this strategy, the strong downside protection coupled with upside optionality. That downside is achieved through the short tenor of the assets, the high current income, as well as the structural protections, most notably that many of these assets have front-loaded cash flows, are senior in the capital structure, have over-collateralization or strong asset coverage, and again, are diversified at the portfolio level. The upside potential is present in many, although not all investments, and has the ability to meaningfully increase the total return of this investment strategy. From our perspective, the upside potential of the strategy, coupled with the strong recycling, contributes to the opportunity for this to generate an attractive multiple on invested capital, which was one of the highlights from our discussion in terms of the structure review. We would further highlight that the Ares platform, the scale provided by being associated with the largest private credit investment manager in the industry, as well as an investment manager that manages over $35 billion in private equity, $65 billion in real estate and infrastructure, and over $205 billion in credit, affords distinct sourcing advantages, as well as allows the manager to speak to scale. From the concern side, we do recognize that there are a limited number of realizations in the fund. To date, 40 of the 43 investments have been unrealized. We were able to get comfortable with this because of the significant cash on cash return. Again, Fund 1 has generated $1.2 billion in realized proceeds, largely driven by cash on cash returns. That speaks to the cash flow profile of this fund. We also take comfort from the fact that 38 of the 40 unrealized investments are performing in line, if not above their original underwritten return. We also have underwritten the previous strategy of this manager as documented in the investment memo. We would further highlight that asset-based strategies are inherently operationally complex, and Ares' approach, given its breadth and differentiated returns stream, is particularly so. That is one of the reasons why we are looking to partner with the largest private credit manager in the industry. We believe Ares has a robust and institutional operational infrastructure in place that includes extensive staffing, documented processes and procedures, strong separation of duties, a solid technology platform, as well as a comprehensive compliance program. So in summary, Makita believes that Pathfinder 2 represents an attractive, opportunistic asset-based private credit strategy with strong downside protection and upside optionality, and is a strong fit for the New Mexico State Investment Council. I'm happy to take questions.
I think if we could turn it over to the folks from Ares for their presentation, and then we'll take questions at the end.
Sure, go ahead.
Council members and staff, just wanted to thank you for the opportunity to supplement the great introduction from both Mary and Tom, and thank you for your consideration. We've had the opportunity to work with SIC in the past, so hopefully Ares is not a new organization to you all, but if you want to flip ahead, just a very quick intro on the firm. As Mary alluded to, we have $352 billion in assets under management. with 30 offices around the world. The bulk of those assets that we manage is within credit. So obviously the topic of the day so far. That is across liquid securities as well as direct lending, and affectionately call alternative credit. Ares is built on a culture of collaboration, and there's no group that really exemplifies that more than alternative credit that really benefits from being part of the larger platform and differentiated sourcing that they can do jointly across the organization. So thank you again, and I'll hand it over to Joel to take you through a little bit more on the alternative credit team and obviously answer any questions you may have.
Sure. Thank you for having me. And I feel like the person who's about to go on stage and you sit there for 8 minutes getting an introduction and you start to blush at the end. You know, you're used to saying some of these things yourself. You're not used to having other people say them for you. So I won't reiterate too much of what's already been said because I want to make sure we open up time for questions. And I know we have a short time period dedicated to this. I think the things that wrap in with the discussion you guys have had earlier today, they really correlate with what we've done is a lot of what was hit on by Tom and by Mary, which is, you know, a lot of people talk about diversity. There's diversity where you may make in private equity 30 or 50 investments. If you think about what we do, every single investment we make is a portfolio. So every single investment has underlying diversity to it. So there's more diversity effectively in Pathfinder and Pathfinder 2 will have more diversity than you normally would have across most of the rest of your credit portfolio because you have 40 plus underlying portfolios. So that's really what leads to it. And I think the other thing, as we talked about earlier today with regards to rate movements and other things, we've been saying for the last few years, the greatest protection against inflation, the greatest protection you can have against rates is cash on cash. It's what Mary hit on with regards to realized proceeds and getting cash on cash. And so when we're looking at our portfolios of loans, leases, and receivables, we're always first and foremost focused on that downside protection. The number we're most proud of is we've been doing this since 2011 from an Ares standpoint, over $25 billion of investments, and we have less than 1 basis point of annualized loss. That's not good. That's better than IG good if you think about it from a loss rate standpoint. So first and foremost, you know, we're always focused on downside protection. We do sometimes try to structure some upside optionality. We do generally outperform during dislocation because if you think about the efficient market side of things, when they become inefficient, it creates opportunities. And so the last thing I'd say is everything we do, and it really goes to the flexibility we have in the fund structure, is done with a relative value lens. And every fund manager talks about relative value. But if you think about normal relative value, it's done slightly with blinders on. You know, you're doing relative value, but in a very niche space. You're doing relative value in a very defined form. Because everything we do has the same process and the same profile, it allows us to skip things that just become uninteresting, right? When there's pockets in the market, you talked a lot about some of the rate changes and things. There's a reason, you know, it becomes hard to invest in assets that have very low return on assets, very low cash yields. And so the key is to always be focused not on what your IRRs are, but what on your return on assets are. It's always looking for those areas that have those higher return on assets. And that allows you to be less susceptible to, frankly, what happened with Silicon Valley Bank. You know, not only was it treasuries, but they owned agency mortgages, Ginnie mortgages, where they had very low rates. And as you can imagine, nobody prepays very low rates on their mortgages. So not only did they have the convexity, but they also had the duration lengthen on them and hurt them in a bigger way. So our focus is always a very big cash on cash. It's always looking at the downside protection of the portfolios. It really means we lend. And to Tom's earlier point with regards to lending, when we lend floating rate. You know, we're not looking to take that rate risk across the underlying investments. And so, you know, when you think through, you know, the way we kind of approach the markets and other things, this is actually Fund 5 for us. We call it Pathfinder 2 just to confuse people. But it's we actually on the last fund came up with a charitable tie-in that does not come out of your pocket, it comes out of our pocket. And with that, we actually renamed the fund Pathfinder. You know, you guys are in New Mexico. I'm a poor preacher's kid from Oregon and Idaho. So when I drive through here, it looks a lot like Idaho. We have a charitable tie-in where at least 10% of the promote out of our pocket, half from the team, half from Mary's, goes to global health and global education charities across the globe. And so we take our fiduciary responsibility very, very seriously, but it also allows us to do what I love to do on the investing side, but also kind of have a charitable tie-in that's also tied to that extra portion of it. So that was the reason for the renaming with regards to the last fund. So look, I would open it up to any questions because we've covered a lot of credit related topics today, obviously. But I'm always, as Avni and Tom knows, and Mary, very, very willing to talk markets, but also willing to answer any specific questions with regards to the fund. I hit my 5 minutes.
You did.
There you go.
Thank
So
you
are there any
all. We're going to now turn it over to questions from council.
Madam Chair, just a question about your ESG policy.
Mhm.
How do you implement that? And why did you institute it? Was it pressure from peers, or did you think it was something to do, or the regulators are certainly okay and are forcing you to do that?
Yeah, I would say it's less directly applicable as it relates to our space, because as you can imagine, if you think about everything we do, it's portfolios of loans, leases, and receivables. At the end of the day, it's a person or it's a consumer. It's a person or a business that's paying us on those contractual cash flows. So as you can imagine, there's no large portfolios of contractual cash flows of coal or firearms, right? You know, so it doesn't really apply into our space as much as it does into some other areas. We have invested in things in oil and gas. We have invested in things on the fossil side. And so, you know, the ESG policy from a firm standpoint really is more about risk than it is about other areas. If you think about the areas where there has been screens, it's areas that frankly are bad investments, right? If you think about investments across some of the areas, it's for risk reasons. It's not necessarily for the underlying. I look at it as you know, the near and dear to my heart is what we've done on the charity side. You can have a lot more positive impact with regards to what we're doing. We hope that that becomes something that other funds start to do more than across that, but it's been implemented across the firm. We have our own underlying all credit policy as we relate to it, but it doesn't impact what we're looking at from an investment. We're not giving up returns with regards to investments, with regards to how we go through in our investments.
Anyone else?
One question, one comment. Madam Chair, I think this would be more for staff. How did we determine 300 million for this particular item?
Sure. So one reason we determined 300 million, Treasurer Montoya, was just the fact that our pacing plans and therefore our bite sizes need to increase significantly. So our bite sizes in fixed income going forward are going to increase. So if you look at 300 million relative to, I think we're 43 billion total fixed income, it's kind of less than 1%, right? So from an overall standpoint, we're still broadly diversified in what all of our exposures are. But you know, could we have gone higher? Frankly, I think this is a great strategy, and I meant what I said when I was excited. I would have gone higher, but I felt like 300 million is a prudent. If we want to have a broadly diversified portfolio, I feel that 300 million for an individual fund strategy is an appropriate dollar amount. Mary, do you have any comments?
I would echo what you said, and maybe just further make the point that we're comfortable with the cash flow profile of this strategy. We think its emphasis on downside protection coupled with some upside optionality makes us comfortable, you know, taking this size allocation.
Okay, thank you, Madam Chair. I was just curious because all of our other ones are a lot less, and I didn't know if there was an actual equation or structure for it. And also because of what Mary had mentioned, which I'm glad she did comment on, that 40 of the 43 unrealized and that not being a concern. My request would be on page 123, which shows me confidential. If on that last paragraph, if someone can just send the council the manager's allocation policy, I'd really appreciate that. And my last comment is I appreciated reading your ESG policy because I'm always curious, and the comment that you made about your contributions to the communities. I think that's really important as part of being investors. And if it's appropriate, I would make the motion, but I'll wait to see if Madam Chair says so.
Let's see if there are more questions, Madam Treasurer.
I just have one more comment, and that is that Vince kind of indicated this at the investment committee meeting, that because of the substantial inflows into the thanks to the land office and others, because of the inflows, our investments are probably going to be larger over the course of time. We've got a fairly significant amount of dry powder that needs to be put to work. So I think we're going to be seeing investments more like this on a fairly consistent basis, would be my guess, based on the as compared to the past. If there are any other questions, Madam Chair, based on the recommendations of the
I
Council
think Madam Treasurer wanted to make the motion, sir.
I'm sorry?
I think Madam Treasurer wanted to make the motion.
Oh, I'm sorry. I apologize. I didn't hear.
Based on the recommendation of the Council Investment Committee Consultant Makita, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $300 million to Area Pathfinder Number 2 Fund LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
That's a proper motion by the treasurer and a second by member Lavender. Any discussion on the motion before us? Hearing none, we'll have Andy take a roll call vote.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yep.
Mr. Summer.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 9-0.
Great, and we thank the folks from Aries for flying in for this.
Thank you very much for having us. I will say on our website, we have our newsletter called In the Gaps, and we actually talked about AOCI losses, which actually took in January. C4 Silicon Valley Bank went down. So if you guys ever want to read a newsletter tied to a lot of the conversations today, I think you actually would enjoy it. So
All right, we appreciate the offer.
Thank you.
Thank you.
All right, next we're heading to agenda item 3D, and we have a New Mexico private equity vote. So I'll turn it over to Mr. Cassidy.
I'll try to be as quick as I can be, given we're behind here. I'm really excited to bring two new investments for the New Mexico program, Playground Global and Lux Capital. These are two of the premier multi-stage VC firms investing in frontier technology. In addition to these two new investments, just so you know, we have a good pipeline of opportunities for the program later in the year, and excited by the opportunity set we're seeing. At a high level, given the types of technologies coming out of our labs, New Mexico is really a frontier tech, deep tech ecosystem. As we discussed with the Frontier Fund investment, this is everything from artificial intelligence and machine learning, next-gen computing and semiconductors, quantum, automation and manufacturing, advanced materials, energy and synthetic biology, aerospace and defense. Venture capital as an asset class is really dominated by software, consumer and fintech investments. And our ecosystem is kind of unique with this frontier tech kind of focus in terms of the types of companies we're creating here. So we're always on the lookout for great VC firms that invest in frontier technology. Before we get to Playground and Lux, what do we mean by multi-stage funds? These are larger funds that can invest across stages. They can invest at the earliest stage of a company at the seed stage with smaller checks, and at the growth stage with much larger checks. Frontier tech investments generally take longer, and they're generally more capital intensive than some of the other sectors I've mentioned, like software. With due credit to Lux on this point, we believe it's important to invest in several larger stage investors in frontier technologies like Playground and Lux. These larger funds One, they have the firepower to incubate and invest in early stage technologies and science created in the state. Two, they have the capital to protect the emerging winners in our ecosystem with additional growth capital and insulate them from what I think we all expect to be a volatile period over the next 3 to 5 years. And then, number three, and hopefully have these companies emerge in a more stable environment, hopefully after this volatile period that Vince is talking about ends. Given these are larger funds, their average core position in the fund is larger, which gives us an opportunity to write a larger check in the program. We're really excited by their participation in the program. It's really a validation, I think, of the opportunity set that our state's VC ecosystem, with its emphasis on frontier tech, has over the next decade. So first, coming to Playground Global, Playground is raising 2 funds, Playground Ventures 3 and Leader Fund, which is their early growth fund. We're recommending up to $35 million to both funds, 25 to the early stage fund and 10 million to the Leader Fund. They're Playground, like Locks, is really perfect for our ecosystem. The 5 themes that they can look at are quantum and next gen computing, automation and AI, life sciences, logistics and infrastructure, as well as decarbonization of the economy. And on that last point, Playground led the Series A in Universal Hydrogen, which is a developer of hydrogen-powered commercial aircraft. In March 2022, the company announced it will build a manufacturing and distribution center here in Albuquerque. The company anticipates investing over $250 million into New Mexico and hire 500 employees over the next 7 years. And the company, interestingly, recently completed its first successful test launch, which is really exciting, I think, for decarbonization of the economy generally. I'll pass it off to Richard Pugmire from Mercer to talk about Playground in a little more detail.
Thanks, Chris. We're also excited about the experience and expertise that the 2 groups that we're talking about today are going to bring to the New Mexico program. And it really complements the managers that we have in the New Mexico program, and it complements the ecosystem in the state. Playground Global is raising 2 funds, Playground Ventures 3, which is focused on early stage frontier technology investments, and Playground Leader Fund, which is expected to invest in later stage follow-on rounds in existing Playground portfolio companies. The firm is led by a team of 5 general partners with deep industry experience, with an average of 33 years of experience. They've previously worked at technology companies such as Apple, Google, Microsoft, and Qualcomm, and also have experience starting companies and investing in companies. Another differentiator in Playground strategy is a large facility in Palo Alto where early stage companies can be incubated as they develop their technologies. This allows the Playground team to stay close to the management team and more efficiently utilize labs and equipment. From a track record perspective, Playground has generated above average performance to date. In particular, the first fund is tracking in the top quartile on a distributions to paid in capital basis, showing that they're returning more capital back to investors than many other funds in the benchmark. One thing to note is they are investing in early stage technology, so the expected hold periods are longer for these investments, although they have had some of these early successes. So we're recommending a commitment of up to $25 million to Fund 3 and up to $10 million to Leader Fund. And we have on the meeting Peter Barrett, who's one of the co-founders and a general partner at Playground, and Kendra Perlitz, who is an operating partner focused on investor relations. And I'll turn the time over to them for their presentation, and then we're happy to answer any questions.
Great, thanks so much. Really appreciate the SIC's time this morning. Would love to share some images of some of our portfolio companies. And if somebody can enable screen sharing for me, I'll present some of what our portfolio companies actually look like. One of the pleasures of being in a deep tech venture firm is that we don't deal in abstractions. We deal in physical things. And so if I can share some of those pictures, I'd appreciate it. As mentioned, we are an unusual venture fund in that all of the partners are engineers. We've all built technology platforms. We've all created companies. We know what it is to be entrepreneurs, and we know what it is to be engineers. But it's not just us. It's a team of 45 people, most of whom are scientists and engineers and have advanced degrees in bioengineering, in mechanical engineering, in in material science in the domains we invest in. And they collaborate with our portfolio company, some of which share this 70,000 square foot facility with us. So our deep engagement with our entrepreneurs leads our entrepreneurs to think of us much more as co-founders than investors. And that gives us an unfair advantage in our ability to create roadmaps, to be able to figure out how the world is going to be and invest against those roadmaps, as opposed to just responding to the zeitgeist. Now, many of our areas of focus are around building transformative companies that move civilization forward. And one of the most important areas there is the next generation of computation. Civilization's demand for computation is growing exponentially, and Moore's law is not keeping up. And so we have to invest in new kinds of computers to be able to fill that gap and build the things that society really needs. An example of that here is a company called Next Silicon. These devices are actively in use at Los Alamos National Lab and at Sandia National Lab. They have the advantage in that they can run existing software 10 to 100 times faster than conventional CPUs. And these will be an important foundational technology for the next generation of high-performance computing. We are also building the world's first useful quantum computer. Quantum computers allow us to really change the way we develop drugs, we develop materials. Turns out that many of our most important drugs, we have no idea how they work because the chemistry is beyond the capability of conventional computers. But quantum computers will allow us to have drugs which are designed, not guessed at. And this also includes things like catalysts in industry and chemistries, which we have discovered, but are beyond the capability of classical computers to understand. Quantum computers will change that. Now, once you have better computers, you can start to design better drugs. You can start to treat some of humankind's worst maladies in entirely new ways. And we've invested in companies that can do things like industrial scale gene sequencing that can reduce the cost of a genome by 1 or 2 orders of magnitude and completely change the standard of care for using genomics in health. We also are applying AI to things like discovering RNA structures, and for the first time, be able to design drugs that directly target RNA. To be able to reach into your immune system and take the drugs that we all make ourselves to protect ourselves against infectious disease and cancer and extract those drugs and share them with other people. And so revolutions in compute and AI at the boundary of life sciences are going to completely change standard of care for many of our worst maladies. Now, AI is having its moment. We are collaborating with Microsoft on hardware to accelerate ChatGPT by a factor of 100. And we are co-investors in a company that's making revolutionary silicon there. But without sensing and actuation, AI is a brain in a jar and not much good to anybody. And so we have an extensive robotics program where we are building robots that can go out into the world and do useful work. This is a robot called Digit, which is the first commercial robot designed to work alongside humans in human environments and be collaborators, not replacements. Much of the automation in the world is behind a fence. Digit and other robots in the portfolio are designed to amplify humans, not replace them. And with 500,000 logistics jobs unfilled in the US at the moment, these kinds of robots can literally step into those roles. This rocket is the largest 3D printed object in the world, and it launched into space last week. This is a company called Relativity Space that print 85% of the dry mass of this vehicle. And we met them when there were 13 people. They were struggling to raise money in the Valley. And we spent a lot of time with the team and understood the potential for 3D printing for aerospace. These guys have an extraordinary book of business and are moving forward in printing larger and larger rockets to meet a huge gap in launch capacity. And this, as mentioned, is the world's first commercial hydrogen plane. This company, Universal Hydrogen, is led by Paul Eremenko, who is ex-CTO of Airbus. and was frustrated at the slow pace of decarbonization of aviation. So he took it upon himself to start this company. And less than 2 years ago, we led the Series A. Like Relativity Space and all the other companies I'll mention today, we are the largest shareholder in this company. And what we're doing, or what they're doing, is taking out the kerosene dinosaur fuel engines that power these regional turboprops and replacing it with a fuel cell electric drivetrain. Now, fuel cells convert hydrogen fuel and air into electricity and water. So this aircraft emits nothing but liquid water and has all the same flight characteristics of the kerosene-based aircraft, except it doesn't smell, it doesn't vibrate, and it doesn't dump carbon dioxide into the atmosphere. Now, one of the secrets that Universal will have is that they have solved the hydrogen supply problem, right? Hydrogen is an ideal aviation fuel. It's the most energy-dense non-nuclear fuel in the world. And that the trouble is that there aren't hydrogen trucks and pipes. And so they solve this by building essentially these liquid hydrogen espresso modules that are full of hydrogen rather than coffee. And they can be delivered over the existing intermodal freight network on trucks and trains and so forth, then loaded into the aircraft using baggage handling equipment that is available at the airport. So every airport on Earth is a hydrogen-capable airport. Now, these electric drivetrains and these hydrogen modules are going to be manufactured at a facility next to the Albuquerque airport. In phase one alone, over the next 5 years, there'll be construction jobs and manufacturing jobs taking advantage of the extraordinary talent here in New Mexico. And that in subsequent phases, there will be thousands of jobs created. We already have orders for more than 10% of the turboprop class aircraft to be converted to hydrogen. And that was before first flight, which happened on March 2nd. And we expect a very large percentage of the existing kerosene-based polluting CO2 emitting planes to convert to hydrogen flight and enter service at scale in 2025. And I think this opportunity reflects the kinds of engagement that we'd like to see with New Mexico. We have other companies that I can't talk about in the public forum, which are engaged with Los Alamos and Sandia on development. There is a very close affinity to the science and engineering in New Mexico with the team and talent at Playground. I want to thank Governor Grisham for her incredible support on Universal and look forward to the opportunity to collaborating more deeply in technologies that move civilization forward. Deeply appreciate the time. Would love to answer any questions.
Wonderful. Thank you so much, Mr. Barrett, for being on and for your slide presentation, and to our staff and Mercer for all of that good information. I'm going to start with a question that I had myself. So as you all know, I'm very excited about our New Mexico investments, and particularly this one who seems to be taking advantage of the spin-off technologies that we have developed here in New Mexico at our national labs. I did have one thing that gave me pause, though, and that is in the due diligence report by Mercer. So I don't know if Mr. Pugmire wants to take this. This company's connection to being an integral part of Silicon Valley. I'm just wondering, with what we started the meeting talking about, if there's any risk or exposure to us from that.
Are you
Richard,
referring to Silicon Valley Bank or Silicon Valley?
No, it doesn't say Silicon Valley Bank, but I do know that a lot of the Silicon Valley companies were capitalized by that bank.
Yeah, I mean, we did look at Silicon Valley Bank exposure for Playground. I mean, there was there were some financial arrangements that the fund had with Silicon Valley Bank, which is now acquired, so it will go to First Republic. But there was no exposure that we saw that caused value loss.
And just to kind of double click on that, we did do a very in-depth kind of tracking process for our portfolio companies that also had exposure to Silicon Valley Bank. And all of the risk has been mitigated either through the recent acquisition or the fact that Most of our portfolio companies now have dual accounts, one at a national bank and one also at, the existing Silicon Valley or, comparable other regional banks that are very well attuned to the financing needs of startup companies.
Thank you. And that's Ms. Perlitz?
Yes, ma'am.
And you're a representative from Playground?
Playground, yes.
Okay, great. All right. I didn't hear you introduced. Great. So at this time, are there yes, we have member Allen.
Two questions. One is, one of the biggest concerns in AI is who's actually writing the code, and that there's not enough diversity in cultural or ethnic or racial backgrounds in writing code. So how are you looking at the companies that you're working with and making sure that there is diversity in the people that are creating the AI implementation? So that's one question. The other question is, hydrogen does take water. We're a state that doesn't have a lot of water, and we're going to see water being, I think we'll eventually have water credits, just like we have carbon credits. How do you see hydrogen growing that will not put pressure on us in terms of having enough water to work with that?
Great. Thank you so much for those questions. So on the AI question, yeah, you're absolutely right. AI often reflects how society is, not how it should be, and is notorious for training in biases that perpetuate injustices. And we are, in one of our portfolio companies, they are now the largest or the most efficient large language model training network in the world. And there is a huge effort on how you curate the training models to prevent them from being racist and sexist and dangerous. And it is, you cannot just take the corpus of the world that's on the internet and train a model and expect something that any reasonable person will be happy with. And so we have scientists and researchers developing the tools to make that AI and those training processes curated and managed in ways that we get AIs that are useful and not destructive. And then the second question, you're absolutely right. Hydrogen production does require water, although the fuel is hydrogen in its liquid form is so incredibly dense, you need a tiny amount of water for a flight. And so those modules each contain about 200 kilos of liquid hydrogen, which, you'll get many of those modules filled from a backyard pool. This does not consume water the way an industrial process does. And it's really just a testament to the energy density of hydrogen. You just don't need very much water in order to fill those planes.
Thank you.
Other questions?
Madam Chair, I have one question.
Madam Chair.
On the one that we're doing now for Playground and Lux Ventures, are these connected or tied to one another?
No.
Okay, thank you.
Madam Chair, this is Kurt. How long do you think it'll take to build out the factory and do conversions to conventional aircraft that is out there today?
And so I can give you a more nuanced answer. I know that they will be in full-scale production in 2025 for the modules that are going to enter service and the drivetrains that are going to enter service. The factory does have multiple phases that will grow over time, but that 500,000 square foot facility will be fully built out by 2028. But we have customers entering service in 25, including the world's first hydrogen-only airline. And that we, to satisfy the orders that we have coming in, we are going to have to scale that factory relatively quickly.
Thank you.
Anything further from council members? Hearing no further questions, we're ready for a motion.
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff in general, fiduciary oversight of RVK, I move the State Investment Council approve a commitment in aggregate of up to $35 million to Playground Ventures 3 LP and Playground Leader Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second. Alan?
Okay, we've got a proper motion by member Lavender, a second by member Allen. If we could, I'm sorry, is there discussion on the motion? We could have Andy take a roll call vote, please.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
I'll abstain.
Secretary Props,
Yes.
Mr. Lavender.
Yes.
Mr. Summer,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0 with Treasurer Montoya abstaining.
Okay, very good. And we appreciate the folks from Playground for being on with us today.
Thank you.
Thank you so much.
Okay, with that, we're going to move to agenda item 3E, which is our final investment vote of this meeting. And it's a recommendation for Lux Ventures 9. And I'll turn it back over to Mr. Cassidy.
Thank you. We're recommending a commitment of up to $62.5 million to Lux Ventures 8. Lux, if you're unfamiliar with them, they're a multi-stage, one of the larger multi-stage venture firms focused on frontier technology. They invest at the intersection of technology and hard sciences, focusing on life sciences, physical sciences, and computational sciences. In addition to our state's national labs and universities, the Santa Fe Institute, one of the state's great research institutions. For those of you who do not know it, it's an independent nonprofit research institute dedicated to the multidisciplinary study of complex adaptive systems. It has an incredible network of academics, research scientists, and investors, which we think is an untapped resource that the New Mexico program can take advantage of over the next decade. Josh Wolf, one of the co-founders of Lux, is a trustee at the Santa Fe Institute and has helped recruit other luminary investors to be trustees. Lux's investment strategy, which is also multidisciplinary and invested at the intersection of technology and hard sciences, really maps, similar to Playground, nearly perfectly to our ecosystems and its strengths. I'll hand it off to Richard to discuss the fund in detail.
Thanks, Chris. Lux Ventures 8 has a technological focus on life sciences, physical sciences, and computational sciences that are complementary with the state's technology ecosystem. This is a larger fund than what you typically see in the New Mexico program, with Lux targeting over $1 billion, but it's a multi-stage fund that has the potential of making larger investments in companies. And I'll focus on the fund, given the background that Chris has shared with the New Mexico connection. Lux was founded in 2000 and has raised more than $4 billion in commitments. The firm was founded by Peter Hebert and Josh Wolf, who still serve as the firm's two managing partners. The firm and its founders have a strong reputation in the hard sciences space, given their history and successes in the industry. And the team's grown to include 8 additional investment professionals, including 5 general partners and 2 partners. The fund will have the ability to invest across stages in the target sectors. The fund's expected to target everything from seed stage to later stage companies. And this single fund model helps it support a company from beginning to end. And post-investment, Lux also takes an active role in creating value of portfolio companies, which we like to see. From a track record perspective, Lux has a strong track record across 9 previous funds in total. They've also been able to generate realizations, as prior funds are generally above median on a distribution to paid-in capital basis. With that, summarize, we're recommending an up to $62.5 million commitment to Lux Ventures 8. I did want to mention too, my answer with SVB on the last one, it's First Citizens that's involved with the acquisition of SVB's private bank. We did ask Lux that same question, and they reported no material financial disruptions to Lux or its portfolio companies due to the SVB situation. And with that, I'll turn it over to the Lux Capital team for their presentation.
Appreciate the time and attention and interest from everyone. It has been great working with Chris in particular and understanding the needs and desire of the program in New Mexico. And we're excited to participate and help contribute significantly. Lux itself, we're a team of 35 investment professionals, primarily U.S. offices in Menlo Park on the West Coast in California and in New York City. Team is comprised of folks with advanced degrees and PhDs in everything from material science to physical chemistry to computer science and life sciences. We are, as noted, in our second decade, currently managing $4 billion, and we're closing our 8th fund, which is Lux Ventures 8. The primary focus is early stage, and that is often at the intersection of technology and hard sciences. And notably, in recent years, we've distributed over $1 billion to limited partners. We do like to say that we invest at the intersection of the inevitable and the impossible. And those are situations where other investors, our peers, our competitors either don't know about a sector yet or don't believe that something is possible yet, or might incorrectly believe that it's going to take a lot more time or a lot more money and capital than is typically viewed. And we have a contrarian view or some sort of privileged variant perception, some different take. We do invest at the cutting edge and take this sort of contrarian approach so that we can find the most important technology companies that ultimately are going to be the key companies that are defining in their sector so that they can deliver the fund-making returns and help us hit our target, which are typically 3 to 4x cash on cash returns for our limited partners. Broadly, to think about how we invest in some of the main categories, and you heard this in the intro, there's core technology and the computational sciences, there's life sciences, which includes everything from cutting edge biotech and medical devices to robotic surgery and to healthcare IT. And then the physical sciences, which include material science, chemistry, and physics. But importantly, it's really at the intersection or the interstices of these disciplines where some of our most important companies come. And so that might be at the intersection of artificial intelligence and biotech, or the intersection of aerospace and defense and autonomous systems and machine learning. We also like to be, as noted, the first or founding investors in companies, both to establish a strong early ownership position, but also because it really gives us a proprietary source of deal flow, actually creating companies that did not exist and might not have existed had we not formed them with the founders or the scientists or the entrepreneurs or some thesis that one of the partners or multiple partners at Lux might have had. So originating companies de novo from scratch typically gives us very high ownership for very small dollars and is also very reputation enhancing because we get other investors that then want to follow on our companies. I'll give you some quick examples to give you a sense of the range from high-tech nuclear waste cleanup to biotech to aerospace and defense. And then I can turn it to some of the other folks here and answer any questions. Curion, named after Madame Curie, but spelled with a K, was a company that Lux formed about a decade plus ago. This was something that we took a contrarian approach at the time when the rest of the venture world was very focused on alternative energy and clean and green. And we thought that the one thing that was absent from the conversation was nuclear, and specifically the biggest unsolved problem of what you do with the waste. We actually spent a lot of time at Los Alamos diligencing technology and working with consultants there to assess where there might be investable opportunities. We ended up forming this company de novo. We owned in excess of 35% of it for a small dollar investment. When the Fukushima disaster happened, this was the only US company that was picked for the cleanup that had the material science, the chemistry, the robotics to be able to go to the Fukushima disaster and help remove 98% of the cesium, strontium, technetium, uranium, plutonium, et cetera, in that waste disaster. We like to say that we invest in matter that matters, that there's an underlying moral underpinning in a lot of the things that we invest in. And so this contrarian approach, when everybody was tacking towards solar and wind and biofuels, and we tacked towards nuclear and then found the biggest unsolved problem, formed a company, brought in the best people in the industry, was something that we were very proud of, and then also delivered a 34x return on that particular investment. It returned the entirety of our fund to our investors and then some, and it's something that we like to do time and time again. Another example led by Peter, co-founder who's here on the call, was a company called Auris Surgical Robotics. This was a robotic surgery platform where we took the founder of Intuitive Surgical, Fred Moll, a real legend in the industry. It was his second act. He saw that technology had advanced further, that now it incorporated AI and software. You can navigate inside of a body without causing scars and help people with late-stage lung cancer. We ended up being the earliest investors. Pete was the lead director, ultimately through its sale to Johnson & Johnson for $6 billion, another great fund maker for us. and something that we were early to that many other investors had not really identified as an important area. Control Labs, spelled CTRL Labs. This came from a hypothesis, and we have a lot of these. Sometimes they're fun to kick around, of what we call the directional arrows of progress, certain technology areas that we feel are inevitable and others deemed to be impossible. In this case, it was the way that we interact with our computers. If you go back in history, we had large mainframes that we used to stand up and pull levers and plugs. Then you had desktop computers, then laptop computers, of course, mobile phones today, wristwatches and AirPods and whatnot. And we had a hypothesis that the next wave would be about the physical and material sciences. We ended up starting this company around a researcher named Thomas Reardon. He had figured out that you could create a wrist-borne device for neurology, neuroscience, combine it with AI, and let you make simple gestures to control computing around you. In just under about 2 years from our investment, Facebook, Meta bought them for just under $1 billion. Anduril is another sort of iconic company. We were founding investors here, is today a leader in high-tech US and allied defense. So specifically focused on the defensive part of this. We're founding investors when it was just valued in the tens of millions, today valued over $8 billion with nearly $2 billion of cash and starting to acquire a lot of its peers and competitors. Maybe just 2 or 3 other quick examples and just to give you a flavor. Icon, leader in biotech, where we commercialized the Nobel Prize winning work of Eric Betzig. He invented a very key microscope to let you see inside of cells in real time, watch how they metabolize drugs and give insights into life-saving medicines that never existed before. We then brought on Roger Perlmutter, a true legend in the industry who ran all of R&D at Merck and Amgen. He raised $500 million for that company and is now looking to roll up the biotech sector. And then maybe 2 others real quick. Hugging Face, which has, in our view, one of the most ridiculous names. It's very silly sounding, but it is a very serious company. You heard a little bit about AI before. This is one of the key properties. Before the AI hype curve had begun about 5 years ago, we funded this team. Some French PhD researchers came to the US. They're now distributed throughout the country, but own one of the key properties for the repository of all of the AI models in machine learning and artificial intelligence. Most recent round funded by other top tier peers like Sequoia Capital valued the company at $2 billion, many deca multiples of where we originally invested. And lastly, Impulse Space, an example of the network of Lux being able to reach into some of the top companies where the best talent is coming out of. In this case, a lot of great talent is coming out of SpaceX. We took the founding CTO, Tom Mueller, and helped to fund him in a company called Impulse Space, which has launched a new company that's focused on the unmet needs in space logistics and transport. Maybe a quick comment about the environment. You guys have been talking about that a lot today. We think this is a setup for outstanding returns, both within Lux. Everything here in our franchise is going up and to the right. It's our firm's reputation, the network know-how, our companies, the desirability of entrepreneurs to work with us. All of that is great. But there is one thing that is going down, and that is entry valuations. And so with the dislocations in capital markets, you are seeing Series A's at somewhere between a fifth and a tenth of recent valuations, a significant fraction of what they were just a few years ago, which means that if those companies that we're investing in today are successful, the returns have the opportunity and potential to be a significant multiple on cash invested. There's a lot of different strategies, as you heard before, from de novo newcos, where we capitalize the companies very early on and insulate them from the environment, to even doing special situations where we can take advantage of the current environment and invest in later stage businesses, but at early stage prices, because their investors maybe have inadequate reserves and whatnot. Quick note on New Mexico generally, I'll say we're very excited to have the chance to partner with you all. I spend a lot of time in the state, in Santa Fe in particular. I am a trustee, as noted, of the Santa Fe Institute, serve on the nominating governance committee there, where we've recruited to the board great investment and tech minds, including one Albuquerque native, Ian McKinnon, who previously ran Ziff Brothers Investments, and state is near and dear to him, and his wife, Summer. Bill Gurley of Benchmark Capital, a legend in the venture industry. Jim Pilata of Tudor Investments. Toby Shannon of Spotify, Darla Moore, great investor and a widow of Richard Rainwater. And we also host an annual confab there that some of you may have attended at the intersection of tech and aerospace and science fiction, called Interplanetary, which is held at Delancik. Also a founding member of the Taos Innovation Summit, where we bring technology entrepreneurs and venture and macro investors and public market investors for a half-week gathering there. And we've also held events in Albuquerque and convened lots of great technologists and investors, and working with Chris and you all, look forward to really shining a spotlight on New Mexico and helping bring talent and investment to the state. So I'll pause there.
Thank you, Mr. Wolf. Wonderful. So we're going to turn it over to council members who have questions. Any council members with questions?
Just a question on the Santa Fe Institute connection. Are there projects there that you fund, or is that just certainly a melting pot of very smart people? What connection besides being a trustee do you have with the SFI?
There are different programs that they have. So one of the important ones, and some of you may know Melanie Mitchell, she's become a very key link in elucidating the development in AI, some of the limitations, some of the criticism around hype, and as you noted just earlier, some of the problems inherent in the training of the models and the inherent bias. So there are collaborations that we do with some of the individual fellows around certain technology areas. SFI to date has not been the same as a government lab or a university where you have tech transfer. It is more of a smorgasbord of brilliant minds from different sectors that come to really think about some of the big problems and challenges and opportunities facing society. But it's something that we would love to do, to bring a more venture component to SFI. They've toyed with things where they had a little incubator right inside of Meow Wolf. Some of you may know John Miller, who's one of the key founders of complexity theory. And that had some things ranging from 3D printing to 3D modeling, inviting entrepreneurs locally, and many of the postdocs and students and even some young folks to participate in that. So I see a lot of opportunity there.
A long time ago, I was John Reed's liaison to the SFI. There were a lot of really terrific thought leadership things, but I was trying to figure out if they were really doing something venture-wise, but not. It would be good if they could. And our state doesn't, I don't think we value what they do or understand what they do. I found a lot of people in the state don't even understand what goes on in the quality of people. That I'm glad to see you're connected with it.
Yeah, and David Krakauer, who's the lead there, has talked about them not wanting to be this monastery, up on the mountain, but being more part of the metropolis. So I think that's part of their initiative.
Further questions?
Madam Chair, I have a few comments. Just for time's sake, I'll just make the comments I have for the council to know some of the concerns I have, and then if the presenter would like to mention something after, that's fine. One of the things that came up in the paperwork is that in the past 2 years, 2 partners have departed to start their own capital firm. So that was concerning the fee being higher than what is traditional, was another concern. And I know there's a step down, but that's still an issue for me. The write-offs on, I don't even know, am I allowed to talk about this? I don't know if this doesn't say confidential on here. So I think I'm okay. But
Madam Treasurer, I would be careful about divulging specific numbers.
Okay.
But
and that's, thank you.
The loss ratio for early stage strategies like these are higher than what you see in buyouts, for example. That there's nothing abnormal about the loss rates that they've experienced. It's completely normal.
Okay, and that's why I'm sort of talking very briefly, broadly, but I just wanted the council to look at a couple of the concerns that were brought up on page 242, 43, 44, those areas that were a little bit more, for me, I'm a lot more conservative in the risk that I personally take. So I just wanted to bring those up to, especially, the idea of with higher risk, you have to have more write-offs and things like that. And for me, that's a little bit more difficult of a pill to swallow. Thank you, Madam Chair.
Thank you, Madam Treasurer. Anyone further? Hearing none, are we ready for a motion?
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move the State Investment Council approve a commitment of up to $62.5 million to Lux Ventures 8 LP, subject to and contingent upon New Mexico legal requirements and Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
I'm sorry, was that member Summer? The
Yes,
second?
second. Yes.
Okay, we have a proper motion from member Lavender, second from member Summer. You can have Andy take a roll call vote, please.
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
I'll abstain.
Secretary Probst,
Yes.
Mr. Lavender.
Yes.
Mr. Summer,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0 with Treasurer Montoya abstaining.
Very good, and we thank Mr. I can't remember his name.
Thank you.
Well,
Mr. Wolf, yes, Mr. Wolf for being on with us today and for the work of the staff. I'll just anecdotally tell you that I witnessed the disconnect between the work SFI does and the general population when I attended an interplanetary forum. And it was about, leaving the planet and all of these great presentations on interplanetary exploration. And the bulk of the questions from the audience were like, we have to fix our problems here. Why are we talking about leaving the planet? I mean, it was like the most juxtaposed event I had ever been to because it didn't seem like the audience was very much in line with the phenomenal presentations that we were.
Prompted me to move here is they had Brian Arthur. It goes back to I was working for Citicorp, and Brian Arthur had a speech on complexity theory at the Indian School auditorium, and 700 people showed up on a Monday night to hear about complexity
Wow.
theory. This is my kind of place, and they have done they do big issues, more not applied research, more big issues research. But it was interesting to hear that they're trying to move more to adding some ventures. But there's it's amazing work they do on climate change, on diversity. I had them work with women corporate directors on the research they were doing on diversity, again, based on science, but the reason why you need more diverse candidates on corporate boards and what it does to decision making. But yeah, it's amazing how most people in New Mexico don't know who they are or what they're doing. I mean, and they're a great asset. So I'm hoping that Lux will bring in some of that to get more ventures out here.
Agreed. Thank you, Mr.
Great pleasure to see you. And the book that would capture the diversity that was just being discussed is called The Difference by Scott Page. I think you'll enjoy it.
They also are doing work on cybersecurity too. So, I mean, it's just, there is applied things that they're doing, but not as much as, so it'll be good if they will. John Reed for Citicorp was one of the first funders of the Institute.
All right.
Thank you all.
Thank you very much. All right, so moving on, we're gonna turn to agenda item F. Turn it over to Ms. Bennett for our contract renewal vote.
Okay, so Asa Scott of the SIC and Matt Sturtevant of RBK will join me on this item and the next item. And the memo is on diligent page 274. So we're recommending four-year contract renewals for 11 international equity strategies whose contracts expire June 30th of this year. Manager contracts can be terminated at any time with a 30-day notice. And for these managers, there haven't been any significant adverse changes in the firm, team, philosophy, process. None of the strategies have lost significant clients or assets or violated investment policy. So a profile of each manager follows this memo. And contract renewals are administrative. The next item on the agenda includes a request for proposal and a structure study, which is when the managers will be reviewed in detail. And so that's all I have. Land Commissioner.
Are there questions about this particular agenda item from council members? Mr. Scott, you were not going to actually, did you have any information to share with us today?
No, not at this time.
Okay. If we have no discussion, do we have a motion?
So I was, is it the last motion?
It's the last.
Okay, perfect. We'll do it. Based on the recommendations of the Council Investment Committee, Consultant RVK and SIC staff, I move that the State Investment Council approve contract renewals for International Public Equity Managers Alliance, Bernstein, BlackRock, LSV, MFS, Neuberger Berman, T. Rowe Price, and William Blair for a standard period of 4 years, as memorialized and discussed by the Council today, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second.
Okay, we've got a proper motion by member Allen, a second by member Lavender. Any discussion on the motion before us? Okay, hearing none. We're going to have Andy take a roll call vote.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Summer.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 9-0.
Very good. We thank you for that. And next we'll turn it back over to Ms. Bennett for agenda item 3G, the RFP for International Public Equity.
Okay, thank you for the contract renewals. This memo is on diligent page 284, and this is an information only item. So the plan is to issue a request for proposal in April for international active large cap and small cap managers. The international portfolio does not currently have an active manager in either of these targeted areas. And the RFP process is expected to take about 6 months. And then in Q4 of 2023, we'll complete an international structure study and be back to the CIC and SIC no later than January of 2024 with the structure study, a recommended portfolio, which includes a deep dive into the individual managers. And that would be the update for this item, unless there's any questions.
Questions from council. Member Lavender.
Madam Chair, the typically when we've had this kind of massive RFP, council member has participated. I've done a couple, Linda Eidson did a couple, and I can tell you that it's very time intensive. One like this will take some, I know that the stack of books we got for one of the ones I did was about 12 feet high. I think that if any council member is willing to volunteer to do that, be wonderful. Again, plan to spend time with it. I'm comfortable doing it, but I don't need to do it if there's someone else who would like to. So we'll need a volunteer. You can do that through Vince or Steve.
Exactly. So I don't think we're going to take time with that today, right during the meeting, but we'll just open it up to council members. If you are interested in serving on the RFP committee, please see Steve.
That's perfect. Thank you, Madam Chair.
All right, great. Mr. Shipp, are you ready?
Yes, I am, Madam Chair, and I will be super brief today. As I've done just about every meeting since I've been here, you will find a budget schedule for the fiscal year through the end of February. I'm not going to go over that schedule in a lot of detail. I do not see any budget problems through the end of the fiscal year. And then, as I always do, I've included the investment holdings report. I think Charlie mentioned in the new fiscal year, we're going to have a couple of extra funds to add to that report. So be ready for that. And then lastly, I just wanted to point out, well, actually, two more items. I have reviewed drafts for the agreed upon procedure reports in item number 3. Those reports will probably be sent out to everyone by the end of the week. Just for everybody's information, there were no exceptions, nothing of really importance to note. But for our newest member, I think you'll find those very interesting. And then lastly, I just wanted to mention that for the next meeting, we will have a budget proposal for fiscal year 24. This is the budget that aligns with the appropriation request that was recently approved. And then I think Steve mentioned earlier that we have been authorized for 26 employees for the current fiscal year. With our most recent hire, we're at 25. So we have one more person that we'll probably hire or try to hire before the end of the fiscal year. In fiscal year 24, we'll go up to 31 employees. And I would think, based upon my discussions with Vince, that it's very likely by the end of the fiscal year, unless we have some turnover or other activity, that will be pressing on that 31. And when we make our next appropriation request at the end of August or beginning of September, we'll ask for some additional employees. Steve wanted me to mention, and I think this is really kind of interesting. We did hire someone that starts on Monday, a legal assistant. I did want to point out, and I think this is very interesting, she's our first St. John's College graduate that we hired. And we're very excited about that. And I also wanted to point out, looking at her resume, that she has experience at the Museum of New Mexico Foundation. And then secondly, at the Santa Fe Institute, which was recently in our discussion. We're very excited to have her starting on Monday. And that's all that I have, unless there's questions, Madam Chair.
Wonderful. Questions from council?
Just a comment. I worked with Francisca. I am on the board of the Museum Foundation. She's a good find. You'll enjoy.
Thank you. I'm sure you'll appreciate knowing that you said that.
All right, hearing no further questions, we're going to go to agenda item 5A, any old or new business before the council. Hearing none. Our next SIC meeting will be in April on Tuesday, the 25th. And where we will be meeting and whether it will be back in person is TBD, I believe, still, unless Steve has any further information on that. Okay.
TBD, but potentially at the cabinet room.
Fingers crossed, we'll be back in person. We'll move now to agenda item 6. Mr. Woolman, is there any public comment to be read or public members that have appeared in public for this meeting?
Chair, nobody in person, but we do have one message that was sent for public comment. It comes from James Gover. His message to the council is this: we are currently experiencing 3 major worldwide disruptions: the energy transition, the application of AI to everything, and economic and military competition between China and the US-led West. Where does New Mexico find the leadership to help it chart roadmaps through these disruptions that benefit the New Mexico economy? SIC, governor, legislature, national labs, universities, COC. We have immense intellectual resources, but where must the leadership merge to help these resources focus? Again, James Gover. Madam Chair, that's the end of public comment.
Thank you very much. Next, we're going to agenda item 7. Evan, do I have to do a whole motion and things?
Technically, you don't even need a motion, but in the past, folks liked it, but however you want to operate is just fine.
All right, Lavender raised his hand.
So move.
That'll work.
All right. See you guys next month.
Thank you for sitting.